There are several pockets of this country that are still suffering from elevated inflation.
We know the Fed is going to slow it. The Fed has to slow it. We just have to debate how much above 4% they have to go to slow it.
It really is 2023 where you look for inflation to come off further.
If there's any doubt at all about 75, they're definitely going 75.
The Fed is probably going to overdo it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
What a brutal session that was. Live from London for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures bouncing back just a little bit, but TK yesterday, the biggest one-day drop on the S&P going all the way back to 2020.
Yeah, back to the pandemic and all that, but more importantly on a scale basis, let's call it the ninth worst drop in history. What I would say, John, is on a red zone, green zone basis, it was a reset. And maybe it is reset Wednesday. But far more than that, John, is the way we closed yesterday afternoon in New York. There was no sense there of catching a bid.
Almost closed at the lows in yesterday's session, Tom. Lisa, yields higher, much higher. It introduced some uncertainty, not about next week, I'd argue. It introduced certainty about next week. It's a much bigger move. Uncertainty about what would follow in November and after that, and whether this Fed is going to have to go a whole lot bigger for a whole lot longer.
What you saw is all of a sudden people pricing in a likelihood of a 100 basis point rate hike come next week.
Nomura.
And then, Nomura is saying that that's the base case. In markets, about a 1 in 3 chance.
Anybody else joining them?
Well, it's a 1 in 3 chance currently being priced into the market that we will get a full 1 percentage point rate hike, even though that has not been on the table previously, and then a 75 basis point rate hike at the following meeting. What does that do in terms of changing the equation for a hard landing? And I think that is really what we felt. The economic
yesterday
pain
was soft landing Tuesday.
That was the morning, Tom.
Okay,
Then we have the inflation report. And to Lisa's point, it's increased the odds the Fed needs to go bigger, which increases the odds and introduces this idea that they have to do more damage to the economy to get inflation down. Diane Swank was out on Twitter just yesterday, raising the likelihood that you might have to take unemployment above 5 to get inflation somewhere closer to 2.
Moment of silence. El Arian, Summers, Hollenhorst,
just
Anna
fantastic.
Wong of Bloomberg. Boy, they nailed it. They nailed it.
Are we done with the moment of silence?
Yeah, we're done with the moment.
But I was going to say that actually talking of Larry Summers, he came out and he actually supported a 100 basis point rate hike as well.
I missed that.
And you saw Jeff Gundlach push against that and say, actually, they should go 25 basis points because they're overdoing it. So, there still is this feeling
we saw that
out
in the
there.
opening. I mean, the distinction yesterday between Mark Cabana of Bank of America and others was remarkable.
Mark Cabana of Bank of America, bear in mind Mike Gapen over at Bank of America is looking for a recession next year. Mark Cabana essentially said the Fed is going to overdo it. And what happened yesterday was an inflation print that will encourage the Fed to overdo it.
Yeah, and at a certain point, isn't it by design, right? What does it mean to not overdo it if they're trying to get the unemployment rate up, right? So where are we talking here in terms of what's an acceptable amount of pain and what's an unacceptable amount of pain? And when does it just become a political issue where they have to respond?
Have you got used to a 2-year that looks like 370? 380 even.
Almost 380.
Oof.
Yeah, well, at what point does it get back to 4% if that's where we think that the Fed funds rate is going to be?
Futures with a small bounce this morning. Good morning to you. I'll whip through the price action just briefly. We're positive by about 0.5% on the S&P 500. Euro showing a bit of strength, just about parity on euro dollar. Yields higher, much higher, and we add some. I have another 2 basis points on a 10-year. Lisa, 343.33.
All right, so today is not PPI Wednesday. I'm just going to say that. We are getting at 8:30 a.m. Eastern Time, U.S. August PPI, producer price index for price. Well, it is technically, but do we care? And the only way that we will actually care about this number, and this is my editorializing here, is if it comes in more hawkish or hotter than we expected, because then it will fit into the narrative that we heard yesterday. If it comes in weaker, does it really move the dial? I don't think so.
It's hot in here, isn't it?
It is hotter than we had expected in here. At 10:30 a.m., we get the EIA crude oil inventory report, getting the latest read on the U.S. inventories of oil and gasoline. I am curious to see whether we actually are seeing a real fall off in demand, if that's really the story here, or if it has been just an SPR release full and through and through. And then today, just sort of moving into this question about COVID zero. China's President Xi Jinping is beginning a 3-day travel, the first since the pandemic hit, abroad. And he's going to be in Central Asia, and he's going to meet with Vladimir Putin. And I find this really interesting because it comes at a lot of talk about whether they're going to continue zero COVID. Does it signal anything that he's leaving the country?
A foreign trip.
She's really read in this
There we
morning.
go. That's a good thing.
It's a good. You and I were out having Vindaloo last night, and she was home reading.
We were working out whether we should bring on a bull or a bear or someone who was
Let's
just
do both.
someone who was just right. Let's get to someone who was just right. Max Kettner, Chief Multi-Asset Strategist at HSBC. Max, we all read your note. Max underweight. Now, you can tell me what that means in a moment, but you have not been constructive on this market, and I imagine you're still not constructive on this market.
Not particularly, no. I think, if anything, if we look at the number yesterday, right, that strengthens this kind of positioning, unfortunately. So I'm delighted to see that you three are still very upbeat whilst talking bearish. I'm not doing as good a job. I'm dragging myself down, so I'm not sure whether, at the end of this section we're all going to, feel a bit more bearish, perhaps even more. Look, I guess the point really that I would make is it's not really about whether we're going to get 75 or 100 in September. What it's about, I think, if we look a little bit ahead, right, it's about we all sort of thought, OK, it's going to be 75 or 50 or 75, then it's going to be 25, and then it's going to be 0, and then they're done, and da-da-da, right? The point now that what the number does yesterday is perhaps opening the door, at least to market pricing, not that the Fed has to do it, but to market pricing in the following meetings to say, actually, are we really need 25 basis point steps, or do we need to continue doing 50 or maybe continue doing 75, right, for the next 3, 4, 5 months? So where's the valuation support going to come from? It's just simply not there. Right?
Do those rate increases diminish demand?
Not yet, right? That's the big issue, right?
But
not yet.
What's HSBC's, and particularly with your Asian perspective, when does demand actually get diminished, according to a textbook everybody forgot years ago?
Yeah, I guess that's the big issue at the moment, because it does take time, right? It does take time. When you look at all of our models are basically saying, look, we had an inventory overhang that's now feeding through into manufacturing PMIs. Now we're starting to see housing weak. That takes around 3 to 5 quarters until it feeds through into the labor market, right? That then feeds into sort of forward-looking consumer data. So we're then talking about well into 2023 for that weakness. That's the big issue, right? And the big issue with demand now is that whether demand craters or not doesn't really matter, right? Because you got two scenarios. You have the scenario where already now demand is getting destroyed. So earnings expectations, growth expectations will be proved to be way to be bullish, right? And that's bearish. Or on the other hand, you say, well, actually, it's not happening yet, right? But that means we're going to get further. And that means it comes from valuation.
Is this a bad news interview?
I think this is a bad news interview.
Well, but
any news is bad news.
But it's good news that we have you on and to talk about what that translates into what you actually are buying. And you were talking about how if you start buying anything other than crawling just into a bunker, it will be developed market sovereign debt. Are we there yet? When do you see the value in some of the yields where we're seeing them get to?
Yeah, I guess, so first one, what would we do right now, right? What you do right now in an environment where real rates go up and break-evens go down, what you do is you go into the dollar. What you actually find is that bonds don't do well, right? Equities don't do well. You can't do an awful lot of relative value trades. Credit doesn't do well. EM doesn't do well. High beta FX doesn't do well. Nothing does well, apart from the dollar, right? So you go into the dollar, you go into floating rate notes, you go into short-dated credit, you go value over growth, those sort of shorter duration trades. That's what you do right now. The signal that I'm waiting for, perhaps for developed market sovereigns, now, if I was a classic strategist, which obviously I am, is, I would probably say, well, if the market at some point is more convinced that growth is really going down, but that doesn't help us. I think the signal, the market signal we want to look out for is if the dollar goes up and the yen goes up simultaneously. Because what that means is that it's big-time recession fears that are now taking over.
Okay, I'm so glad you brought up the currency and the dollar. We heard some job owning overnight. We heard an attempt by the People's Bank of China to try to strengthen with the peg that was the strongest ever relative to where it had been. But really, it was the Bank of Japan saying, we're going to do something, and we're not going to announce when, and we're going to come out, and you guys watch out, but we're going to intervene, maybe. Even though we don't know.
It doesn't sound like you believe them at all.
Well, I mean, we don't know anything. So do you lean against the dollar trade? Do you lean into the yen because you're just convinced they will actually do something?
Not yet. Not yet, right? I think that could be the case for, later in the year, perhaps. But the problem now is, imagine if they did some intervention already now into perhaps a 100 basis point FOMC meeting. Imagine they do 100.
Sure.
Right? Imagine they do that. Then they had this one silver bullet that they fired for nothing. So you don't lean into that just quite yet. I think that's going to be something for later in the year. But if and when it happens, right, yen up and dollar up, it means big safe haven flows, big safe haven demand. Why? Because then the market is really concerned about recession. That's when you go into developed market sovereigns.
Let's talk about another signal. You've been bearish all year. What would make you bullish this equity market?
Nothing, ever. I'm German. So there's nothing that can make me ever bullish, right? No, in all seriousness, I think that there is a couple of things, right? When we look at China's credit impulse, for example, that is already rebounding a little bit, right? So that perhaps at the beginning of 2023 could be giving us a bit of cyclical tailwinds. There is other things like sentiment and positioning, right? Sentiment and positioning on our measures was around about 8th, 9th percentile, and in the middle of June, right? That, however, now is around 40th percentile on our measures. So we're not quite there yet. But if really sentiment and positioning, following from yesterday's drop, is going towards 10th percentile again, actually that plays very much into the bull's hands.
Max Kettner, thank you, of HSBC. Good friend of Lisa's. You will not be surprised by that. Tom, that was incredibly bearish, wasn't it?
I'm depressed.
It was realistic, and he said it so cheerfully.
Well, he's been right.
He has been right.
Let's be clear about that.
Yes, and this comes from the camp that has been bullish on treasuries for years when everybody else was leaning against them and has gotten it right. So that's the Stephen Major camp over at HSBC that Max Kettner belongs to.
What were you thinking about that Japan call?
What do you think that I was thinking? I mean, it's just amazing to me. How long can they jawbone before actually doing something?
Sure. Tom, it's got to be about policy, the doing, and not words.
Well, policy and also politics. I would suggest nothing happens in Japan until after the funeral for the Queen. The Emperor of Japan will travel here. There's no way they're going to do anything with the Emperor traveling. No way.
We'll catch up with Whaley of BlackRock on the equity market situation. It was brutal yesterday. We're bouncing back just a little bit right now. Equity futures positive, 0.5%. Live from London. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. European Commission President Ursula von der Leyen will call for radical steps today to stem the energy crisis. That will edge closer to rationing measures and higher taxes on energy companies. The key question is whether von der Leyen's proposal for a 5% reduction in gas consumption survives various negotiations. In the UK, inflation has gone down slightly from its highest rate in 4 decades. The Consumer Price Index rose 9.9% last month from a year ago, a drop from 10.1% in July. Now that reflects an almost 11% decline in the cost of gasoline. Bank of England policymakers meet next week. They're expected to raise interest rates, either 50 or 75 basis points. The Biden administration considering whether to replenish the strategic petroleum reserve when oil goes below $80 a barrel. Just 2 years ago, Democrats blocked former President Trump from filing a reserve at a fraction of that price. Senate Democratic leader Chuck Schumer called the Trump proposal a bailout for big oil. That cost the U.S. billions in potential profits. A strike set for Friday could prevent American railroads from transporting farm products and other key goods. It could cost the U.S. economy $2 billion a day. President Biden is personally trying to break the logjam between railroads and labor unions. Labor Secretary Marty Walsh will meet with railroad and union representatives today. And Queen Elizabeth II's coffin is now at Buckingham Palace. Today, there will be a procession through London to Westminster Hall, where she will lie in state for 4 days before her funeral. Members of the public will be able to pay their respects 24 hours a day. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
In these times, it is wrong to receive extraordinary record revenues and profits benefiting from war and on the back of our consumers. And overall, our proposal will raise more than 140 billion euros for member states to cushion the blow directly.
A target on the back of energy producers, energy companies. Ursula von der Leyen there, the EU Commission President, live from London this morning. Good morning to you. Yesterday, absolutely brutal. Futures right now bouncing back on the S&P 500, positive by 0.6%. This equity market, a 4-day rally amounting to about 5% higher on the S&P, colliding with a hotter than expected inflation print, and the equity market gap lower. Yesterday, Bramo was, shall I use that word again? brutal?
Yeah, please.
It was ugly. It was ugly.
It basically erased the rally that you'd seen over the 4 previous days, to give you a sense of the brutality of the losses.
Brutal.
I'm trying.
I know. You always seem happy about it, which is concerning.
No, I'm not happy about it. I'm just explaining.
Just wind you up a little bit. Okay. Yields up too. Tom, yields higher.
Yeah, and the key phrase there is 4 days. That we gave up 4 days or 4 weeks or whatever on a long-term basis is just more of a volatile inflation churn. Someone like David Rosenberg, expert on inflation, says you never can predict what it can be. What I would say, John, the number one research item I saw was a single sentence: the necessities showed sticky inflation. To me, that was the story.
And that fueled the number one theme for me, Tom, in the Southside research yesterday off the back of this, is the step down the equity market bulls were looking for from 75 to 50 to 25. Some big questions about that now, about whether the Fed can actually deliver that step down, that sequence, over the next few meetings.
We're excited about our Fed show next Wednesday. Really looking forward to that back in New York. Right now, we're excited about Anne-Marie Horton in Washington. And joining us from Strasbourg, France, there's always a reason to be in Strasbourg, for Maria Tadeo. Maria Tadeo, what is the attendance of Mr. Putin at these meetings of European leaders? What is the Putin effect this morning?
Well, Tom, I think that the effect here is that he has created or has seen the start here in Europe of a war economy. I think that when you look at the language from the head of the Commission, that is what's in store for the European economy. She talks now about demand destruction that becomes mandatory. She talks about solidarity from companies. She talks about sanctions that will stay on. She was also very defiant. I think if you move away just from the details of the energy, the market really cares about this. But to me, the bigger point is the fact that today she made it clear the sanctions are going to stay on. And she had a line here, which to me was the key. She said, Vladimir Putin is waging war in Ukraine, but he's also doing that on the European welfare, on the European market, on our economic stability. And this is something that's now a fight between autocracy and democracy. So if you ask me what's the Putin effect, I think it's a war economy for Europe.
Right. Maria Tadeo, the great historian Steven Sestanovich, who's helped us so many times here on Surveillance, tweets out today and writes in the Daily Beast of Putin wanted to be Peter the Great, but Putin maybe being more like Milosevic of another decade in the recent history. Have things changed at the dialogue at these meetings because of what's happened in Ukraine in the last 48 or 72 hours?
Well, it has, and it has to do with the Ukrainian army and the advances that they made on Saturday. And I know we talk about this all the time, and I go on and on about this, but the conversation in Russia has really shifted over the past 3 days. I was struck when on Russian television yesterday, someone went, perhaps we should stop saying the Ukrainians don't exist, that Ukraine is a fake country. There's a huge debate in the country about should we now declare a full war? Is this conscription? But as always, and this is the point, if you're a Russian man, you're underpaid. You've been to military training for a month and you've been watching a war like it's reality TV. Do you really want to go to Donetsk and fight Ukrainians who up until a year ago were your Slavic brothers in the name of Vladimir Putin? I think that's a real question, and that's why he's shielded the Russian population so much from the war on a daily basis. Can he sustain that? That's a real question.
And we've been talking about how even if the conflict does end, or even if Ukraine does make a lot of inroads, it's not going to change the policy. And Anne-Marie, it's really raised some questions as the energy crisis moves global into how to shore up prices for consumers while encouraging fossil fuel companies to invest. And I wonder how much that was behind the story that you reported on yesterday, breaking the news that the White House is looking at buying oil when it reaches $80 a barrel to refill the strategic petroleum reserve.
Yeah, it would have to dip below $80 a barrel, I think, for them to really be able to go after this and do this. But part of the problem they have is that, yes, they were able this summer. They worked really hard with their messaging with this strategic petroleum reserve releases we've seen. Last week, by the way, was the biggest release ever on record. And right now, when you look at the SPR inventories, they're the lowest they've been since 1984. So they're thinking about how do we put some stock back into it and entice really the Permian Basin. And Javier Blas was writing about this just this week, the fact that there's a deceleration in rigs, there's a deceleration in growth in the Permian Basin, and that is what is really going to be relied upon if you are concerned and you are a U.S. official about potential oil price spikes in the winter when Europe and these sanctions come into play in terms of blocking off Russian crude if there is no oil price cap the way they envision it. So they're really trying to make sure they can do a number of things at all fronts. They obviously would want lower prices for consumers, and obviously inflation is one of their biggest headwinds going to the midterm elections. At the same time, they want to make sure that they are enticing these fossil fuel producers and giving them a little bit of a pat on the back to make sure that they continue that investment, because of course a lot of these shale producers need a higher break-even point. It's also interesting all of this comes on the day, not just after the inflation report, but today the president will be going to Detroit to talk about electric vehicles.
AMH, just briefly, can you walk us through how bizarre yesterday was to see the equity market down by 3-4%, to see inflation come in hot and the president almost do some kind of victory lap for the Inflation Reduction Act?
It was a pretty odd moment at the White House. You have hundreds of people there, and someone looked at me and said, this feels like a concert. And it did feel like a concert because there were performances there. And the president, even though he was talking about the Inflation Reduction Act, he did start by saying, this is something I wanted to do when I entered office. So almost admitting that the name Inflation Reduction Act was obviously political spin, and this really was just a smaller version of the Build Back Better plan. But he completely ignored the data. There was no mention of yesterday's worse than expected inflation report at this event. And this was what Republicans really harped on, with Senator Mitch McConnell saying that the Democrats yesterday were, his words, tone deaf.
A strange moment. AMH, great reporting, by the way, down in Washington alongside Maria Tadeo of Bloomberg. Lisa, a rather strange moment in D.C.
Yeah, especially because it was just an incoherent report, and you're seeing people double down on their message. It's not just the White House. We're hearing that around.
That's what politicians worldwide do, right? Futures, positive 0.5%. That was almost diplomatic. This is Bloomberg.
Almost.
Live from London this morning. Good morning. Equity futures pushing higher by 0.5% on the S&P 500. Yesterday, the biggest one-day drop on the S&P, going all the way back to the summer of 2020. That's how big the losses were on the S&P 500. Futures bouncing back just a little bit. Yields are higher again, though, by 2 basis points on a 10-year to 343.33. Your two-year still through 370. And Lisa, seemingly at one point yesterday, it felt like we were going through 380.
It felt like people just basically were going to go straight to 4% and keep it there, because that seemed to be what the Fed was signaling. And finally, the market seems to be catching up.
Just a little bit, Tom, catching up and questioning, not next week, 75 for many, well, perhaps even bigger if you're listening to Nomura. But it's beyond that. November, Max Kettner with us about 30 minutes ago, talking about the need, perhaps the willingness of this Fed to go further. And then we have to think about the consequences of that, the damage that it will do to this economy to get inflation lower.
I would make it global, and the day after the Fed meeting is suddenly important, as you saw sterling at 114.57. In the shock yesterday. Can you imagine a 113 sterling?
Yeah, and can you imagine a 75 basis point hike from then as well?
No, I cannot. As an amateur, I cannot.
We had it from the ECB.
We'll listen to our pros.
We're going to get it from the Fed potentially, and it looks like perhaps the Bank of England might follow.
We speak of economics, finance, and investment, but right now we turn our attention to a path to Monday and the funeral of the Queen. Lizzie Bird, an expert on this, is at one of the most historic parks over Westminster, Abington Green, next to the Jewel Tower, and off her right shoulder, Westminster Hall. Lizzie, tell us about the path from Buckingham Palace to Westminster Hall this day.
Tom, I have to say, there's a helicopter flying overhead, but apart from that, it's eerily quiet here in Westminster, and it's a reminder of the loss of someone who was above politics. Later today, the Queen's coffin is going to travel from Buckingham Palace through the streets of central London, which are closed now, to the Palace of Westminster behind me, and it's going to be a really poignant moment because her children and grandchildren are going to follow on foot, and it will remind many Britons of the moment 25 years ago when Princes Harry and William followed their mother's coffin. You're going to hear the guns fire in Hyde Park, the bells toll in Big Ben, and from the moment the Queen, the coffin arrives at the Palace of Westminster behind me until the funeral, she's going to lie in state on Monday, and people will be able to file past it and pay their respects. You've already had people queuing overnight despite the rain, despite the warnings that it could be 30 hours that they have to wait. Remember, in 2002, 200,000 people paid their respects to the Queen Mother in that way, and so this is likely to be beyond that, an outpouring of national grief, the scale of which we've never seen before.
Lizzie, tell us about the funeral on Monday. I was stunned to see that the Emperor of Japan will attend, but this will be a gathering of world leaders. Who else will attend?
Yes, the capacity of the Abbey is 2,000, and it will be heads of state, royals, dignitaries from all different countries, not notably Russia and Belarus. The invitation hasn't been extended, although Vladimir Putin has said that he wouldn't have accepted it. Vladimir Zelensky as well has sent a message of condolence, but of course we'll have to continue with the war efforts in Ukraine. But it's also going to be a bit of a logistical nightmare. There are reports in the UK press that these dignitaries, heads of state, will have to come on buses because they won't be allowed to come on their helicopters and private jets. So it really is something that has been years in the planning, but it's almost impossible to plan for.
Lizzie, thank you. It's going to be a deeply emotional morning for a lot of people, and those events, Tom, will take place in the next couple of hours. Typically, that walk from Buckingham Palace down the Mall towards Horseguards Parade and then across through Whitehall and onto Westminster perhaps would take on foot 15 minutes or so, Tom. This procession could take something like 40 minutes.
They speak, which I find unimaginable, a 1 hour service, John, maybe an hour and 15 minutes. That just seems to me just not doable. It's got to be longer.
Lizzie talked about the wait there for people lining up to see the Queen live in state over the next 4 or 5 days. Lisa, the waiting time, 30 hours. And by the way, you don't hold your position. You have to keep on moving. Can you imagine doing that for more than 24 hours?
Well, it speaks to the emotion. And I have to be honest, I have been surprised as an American in London how many people continue tearing up or call their parents and are very deeply emotional about how close they felt to the Queen and the loss that they feel.
Some of that will be from the House of Lords. We've been advantaged by Lord O'Neill, of course, with Goldman Sachs for years, or Lord Stern with his environmental effort for the United Kingdom. And then there's Meghdad Desai. He's Professor Emeritus of London School of Economics, but that barely captures his contribution to Indian society in his United Kingdom. He joins us today from India. Lord Desai, what does Prince Charles need to do forward to coalesce the United Kingdom across many religions and many ethnicities?
I think, in a sense, his mother has done that job. She has left behind a very stable, multiracial and multi-religious community. I think, in a sense, she did it by not playing a religious card too strongly, but sort of quietly and steadily. Yes, she is an Anglican, and she played that thing. Prince Charles had said sometime in the past that he wanted to change his oath from being defender of the faith to defender of faiths, i.e. to include every religion. I hope he doesn't do anything like that. His main job is to keep quiet and play it straight as his mother did, and just let everybody rely on the things they have done very well all the time. My main fear is that he may try to innovate too much too soon, and that may upset the cart a little bit. But I think, in a sense, the economy is difficult enough, and I think we ought not to disturb the political balance too much either. So I'm hoping that he will put aside his strong opinions and just govern quietly.
Lord Desai, I'm curious your vision for the Commonwealth going forward, considering some of the discussion since the Queen's death that she was, in some ways, the end of an era. Do you think that the era that comes looks very different from the era of which she oversaw, which changed dramatically under her tenure?
I do, and I have said so in the House of Lords, because I think the time had come towards the last years of the Queen's rule to share the responsibility of heading the Commonwealth with other Commonwealth countries. But she, at the last Commonwealth Heads of Government meeting in London about 4 or 5 years ago, proposed that Prince of Wales Charles, as he then was, should be the head of the Commonwealth after her. So she closed that door. I think so. We have some very powerful Commonwealth countries, some, as it were, hoping to be republics and so on. That is not a problem. But India is a republic and it's still in the Commonwealth. India actually pioneered that solution. But I think it's very, very important that Prince Charles takes into confidence the leaders of the Commonwealth, because they are now substantial countries. India is the 5th richest in terms of total GDP, and there are other powerful countries like Nigeria, and I think he will have to slightly balance it away from the overwhelming importance of the UK as head of the Commonwealth. I think it will require some diplomatic skill on his part, or at least good advice from the Prime Minister.
Thank you for being with us, sir. We appreciate your input on an important day for this country. Those events that we've been describing in the last 5 or 10 minutes, they're going to start at about 9:20 Eastern time. We'll catch up with Guy Johnson and Lizzie Burden to guide you through some of those movements, that sequence as the Queen goes from Buckingham Palace onto Westminster Hall. We also need to talk about this market, front and centre for a programme like this one. Equity futures are bouncing back, but yesterday it was brutal, and that's a word you're going to hear a lot from Lisa and I, and perhaps Tom, through much of this morning. Down 3 or 4 percentage points, and a big move through the bond market. 10-year yields much higher, the 2-year absolutely surging as we start to re-engage with the idea that this Fed is not done, and Lisa, they're going to have to do a whole lot more.
What I thought was interesting was that actually longer-term inflation expectations fell yesterday. And the question is not the credibility of the Fed anymore. The question isn't whether we eventually will go back to an era where we will see inflation under control. It's what's required to get there. And the pain changed. The pain factor yesterday changed, at least the perception of it, in markets. And that, I thought, was the most notable shift. Not just where the destination was, but how rough the path is going to be to get there.
They don't just want to beat it down, they want to bury it.
Right.
And to bury it, they've got to keep rates higher for longer. That's what they've been communicating. I mean, Tom, what's bizarre about this moment is that for the Fed chair, he doesn't need to change the script based on what happened with the CPI print yesterday.
Correct.
He just has to repeat what he's been saying over the last month.
We're using an analog to Paul Volcker, and it doesn't work. At that time, we had 10, 11, 12, 14% interest rates. It was a completely different environment. I take real issue with the compare back to Volcker, given where we are. With that said, they've got to use the x-axis, which means they have to articulate their path into 2023. And I'm in the camp, there's way too much communication. There's way too many interviews with John Ferro from President this and President that. He's got to get out and articulate the message.
Is that the promo for our Fed interview?
This is the promo. We have a Fed show where we will consider this.
I keep thinking about that Twitter viewer who wrote in that the only way he could have been more hawkish, Jay Powell.
He's coming with a hawk on his shoulder.
And if he had a hawkish tattoo, a hawk on his T-shirt, just screamed into the camera.
That was probably tweet of the week, wasn't it?
Absolutely.
Well, I like what you said. He could just give the Jackson Hole speech again.
Just rip it out and regurgitate it.
Exactly. Whilst preaching.
Futures positive, 0.4%. Tom can do the sound effects. He's good at that. Live from London. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Justice Department says Donald Trump is trying to have it both ways when it comes to classified documents seized from his Florida home. In a court filing, the government says the former president argues that the documents are personal property and also covered by executive privilege. The government wants to keep using about 100 documents, while a so-called special master reviews them for privilege issues. In Japan, the yen has rallied further away from the closely watched 145 per dollar level. According to Nikkei, the Bank of Japan conducted a so-called rate check in the currency market. It's a move considered a precursor for intervention. The yen has fallen more than 20% versus the dollar this year due to the widening interest rate differential between the two nations. Travelers in Hong Kong with COVID will no longer have to stay in isolation hotels or quarantine camps. Instead, they'll be allowed to remain in designated quarantine hotels. That marks another easing in the city's travel policy. The move comes as Hong Kong prepares for several high-profile events, including a summit for global bankers and an international rugby tournament. In Germany, the government is open to the historic step of fully nationalizing the country's biggest natural gas importer. The concern is that the energy system faces a collapse. Chancellor Olaf Scholz's administration is ready to inject more capital into Uniper and increase its stake to above 50%. Uniper lost $12 billion in the first half of the year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
We've been bullish for 2 years now, and all we've seen is this sort of gyration, particularly led by uncertainties around demand. I think there is a degree of sort of confusion as to where demand will ultimately emerge or trend to over the medium term. We still believe that demand will ultimately continue to grow to 100-700 million barrels by 2030.
Kristen Malik, the global head of energy strategy at JP Morgan Securities, so cool to catch up with him just yesterday. Equity futures right now up 0.4% on the S&P 500. If you want to take a look at crude, positive by about 0.75% at 87.93. What did AMH's reporting point out yesterday, Lisa? They're going to come in potentially buy at $80 to refill the SPR?
Right, that once it falls slightly below $80, they will come in. And it raises questions at a time when you would wonder why they're putting the floor in for prices there. I mean, that's sort of the speculation. Or is this really an attempt to appease oil companies, saying, look, we do have your back. We're not just driving you out of business.
Can I ask you both, and Tom, perhaps you can speak to this, what you think about how politicized the SPR has become? How politicized
it's always been that way. I was just thinking of that, John,
even
before.
more so.
You're like channeling
recently.
me today.
Well,
you know,
we have that special kind of relationship,
yeah,
Tom. I'm thinking back to the pandemic when the Trump administration wanted to refill the SPR at much, much lower prices.
It's been,
and there was some real pushback from the Democrats at the time.
Political from day one, and there were some experiments with President Clinton where we tested actually what the microeconomics is, the price theory is of what's going on, but nothing like what we're going through right now. And I would suggest some of this has got some real uncertainty to it. We really don't know what's going to happen on the margin as we refill whatever we're refilling. I still don't know. Where is the strategic reserve? Is it?
It's at the lowest.
It's in Topeka, or?
Oh, you mean
like
physically?
The actual geographic location. I'll get you some coordinates.
Topeka, or
Do you think that we would know that randomly?
The precise coordinates of where that.
Get on it,
be.
John.
I'll get on top of it, Tom.
Absolutely. On oil, Olga Karkova joins us now, Deputy Director, European Energy Security at Atlantic Council's Global Energy Center, the Atlantic Council, with some real commitment to talking about the effect of hydrocarbons on our lives. Olga, I want to get beyond the winter and the discussion, the headline discussion, if you will. How does Germany, as John has mentioned many times, change their policy to a better oil outcome? How do the Germans actually affect a policy change?
Thanks so much for having me. I mean, it all starts about completely reshifting the energy system of reliance on Russian energy sources, creating an energy system that is a lot more efficient, looking at alternative supplies and making those connections and those kinds of agreements. So it is an unprecedented shift. And it's also relooking at its industry, one of the biggest economic drivers in Germany, of course. That is why Germany is suffering so much at the moment, is because some of the industries are forced to curtail. So these are the things that the Germany would have to look at.
But Olga, what's so important here is you say that, and every American viewer and listener is deciding if they should get in an Uber today that's a Chevy Suburban. I mean, we look at Europe like it's already efficient. And part of that is nuclear energy led by the French. Do the French reaffirm an atomic commitment coming off of this crisis?
Yes and no. In France, nuclear energy has always had robust support, not so much in other countries such as Germany. Take a look at how long the conversation, starting in February when the brutal war attack started, that conversation about restarting nuclear power plants in Germany has gone on for over 6 months, and there's finally been a decision to extend them for several months, not even maximizing into how long they could be extended, 2-3 months, and that's it. And there's a lot of pushback against that. So yes, in some ways it has reinforced the value of nuclear, clean, reliable energy. At the same time, for some countries, they're still struggling with that. But to add another layer of complexity, we're also seeing climate change and warm waters making it more challenging to cool off nuclear power plants. So this is a barrier that's absolutely is possible to overcome in the future as we anticipate further climate change impacts and further higher temperatures. But this was something that was unexpected to be another layer of crisis this summer.
One of the biggest nodes of disagreement, or divergence, I should say, between the European Union and the United Kingdom, and to some degree the United States, has been how to incentivize energy companies to invest at a time when they want to reduce prices, when they want to reduce the income, essentially, to some of these companies. You're seeing Germany propose nationalizing, for example, some of their energy companies, and then you have the windfall tax, the European Union, the aversion to do so in the UK, and now potentially a floor under gas prices and oil prices in the United States. What's the right approach?
Right. So, yes, Ursula von der Leyen in her State of the Union address did mention addressing revenues and being able to take some of those back to the consumers. Now, that's a different conversation. I think a way to be able to encourage companies to invest is companies and industry, they want long-term contracts. So we talk about 15 years, at the least, 15 years at the least, 20 years ideally. Now, as these countries are looking into what their energy mix will be in 5, 10, 15, 20 years, and also meeting European climate strategy and Paris goals, I think there's a role for the EU government to be very clear about, look, these 20-year-old contracts will still be valuable. And if you're concerned about risk, or if you're not sure about what your energy mix will be like, we will come in and we will mitigate some of that risk for you. But that is the way to drive more investments in the sector, because sector wants long-term commitment, and then purchasers in countries, utilities, nationalized or not nationalized, they want that level of flexibility. But it's also interesting because we're seeing companies respond to that and provide flexibility in terms of attaching and saying, okay, at this point, we can guarantee that you will receive net zero LNG or reduced carbon intensity LNG. We're also looking into, in this many years, of being able to blend in this much hydrogen. We're seeing these new creative tools. And of course, some companies are coming in and saying, can they shorten those contracts in any way? But for the most part, they really want those 20-year commitments to drive those investments.
Olga, thank you. Olga Kukova there of the Atlantic Council. And here's the answer, Tom. They are in the salt caverns at 4 major facilities.
Yeah.
2 in Texas, 2 in Louisiana.
I didn't know that. Amy from New Jersey listening.
Now we all know that. I don't
Bloomberg
remember
Radio.
the coordinates, okay?
Amy emails in
and
and
just
says,
double check.
Amy emails in and says oil's not in Topeka. I didn't know that. I'm learning every day.
I think we knew that much.
Yeah.
Tom. Well, they're going to try and refill it anyway, if crude gets down towards 80.
Exactly. And then there is this political question about the use of the Strategic Petroleum Reserve in a political manner, although you could argue that that's sort of what it's designed for, right? To mitigate crises. The question really is just when you get a crisis.
I'm going to go
crisis ahead of the midterms.
Well, I mean, you could make the argument that that's supported some of the retail spending that you've seen continue to go, which is possibly why we saw a faster than expected pace of CPI.
Okay.
You could make a lot of connections there.
Sure,
but I'm just saying, I mean,
I'm
look, I
open
think
to
it's
explanations. I always am.
Yeah, you'll inject them later.
Do you think the audience detects a little tension here as we're deep into
love
our
each other, and we
8
always
days
have done.
in London?
Been friends for a long time.
Hours.
Positive. 0.4%. Whaley of BlackRock. is coming up very shortly. Looking forward to that after a major sell-off in the equity market, and I think we can call it that. Yeah. It's the biggest one-day move lower on the S&P 500 since summer 2020, and this is a small bounce.
There are several pockets of this country that are still suffering from elevated inflation.
We know the Fed is going to slow it. The Fed has to slow it. We just have to debate how much above 4% they have to go to slow it.
It really is 2023 where you look for inflation to come off further.
If there's any doubt at all about 75, they're definitely going 75.
The Fed is probably going to overdo it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Did you notice that Lisa walked into breakfast this morning, Tom, with an extra skip, hop and a bounce?
Okay.
And a massive smile.
Hold on.
Off the back
I'm
of
not cheering
yesterday's
the losses.
price action. Live from London this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures with a bounce up 0.4%. TK off the back of the biggest one-day fall on the S&P 500 going back to 2020.
Big move. I'm calling it Reset Wednesday because what I really saw there, John, with one exception I'll mention, is that it was just a jump condition reset to where we were before the soft landing disinflation dance. The one exception is the way we closed yesterday afternoon was not good.
At the lows, and now it's a hard landing conversation. And Lisa, credit to you. I'm only joking. You've talked about the reality of the situation, how hard it is for financial conditions to loosen in the face of what this Fed is trying to achieve.
No one is going to cheer a $1.5 trillion rout in the S&P 500. If anyone does, that is a rather unsavory thing. So I don't want to think that anyone to think that that is sort of my feeling here. There is a sense that there is a dissonance out there, a feeling of unreality that is starting to change. And I think that that is what people are looking at.
We're going to see it in PPI today?
Well, does PPI matter, right? It'll matter if it confirms what we heard yesterday. Will it matter if it doesn't? And I really raise this seriously because
I'm with you.
I just think that right now, people are now on the hawkish bandwagon.
So let's set the stage. We're at 75 for next week, maybe something more. And it's really not even about that. It's about what happens afterwards. Because yesterday in that print introduced the risk that this Fed has to go even bigger for a whole lot longer. And I heard that from pretty much every single bank. They were all looking for the step down, 75 to 50, down to 25. And now there's the risk that doesn't develop.
This is the conundrum, right? If you allow consumers to keep spending, if they get a reprieve from gasoline prices, then they have a better time of it. Then does that actually lead to a more aggressive Fed that has to curtail the economy that much more dramatically and harshly?
How much damage are they willing to do, Tom? Unemployment into year end. Next week's interesting, not just because we get a rate hike and a news conference with Chairman Powell. Tom, it's interesting because we also get the projections in the summary of economic projections. So you get the forecasts. We've had a lot of pushback against some of those forecasts.
I do agree that the forecasts this time around matter after what we saw yesterday. I would suggest with their dual mandate, I believe, John, you mentioned this yesterday in the blur, they have a dual mandate, and the idea that they're going to slam America into recession really pushes against that mandate. I'm in a camp where they may be assertive, but they're going to be assertive over time.
Will that dual mandate be in conflict pretty soon, Tom?
Can we clear something up here quickly? You know, I think it's very important, folks, as John mentions, that we all saw each other at breakfast today. The breakfasts we have are completely different. I'm doing the Churchill full English thing. You're eating some damn oatmeal fruitsy pie granola thing.
Sure.
And Lisa's breakfast, folks, is to go run 5 miles.
And then Bram have room service.
You know,
Lisa
just
won't
so
sit with
everybody
us.
knows.
Lisa won't sit with us.
I would sit
Let's
with you.
Clear.
I get started a little bit earlier, that's all.
At 6:30 in the morning.
Yeah.
Cool. I've got no problem with that whatsoever. Futures are positive. Tom has this massive breakfast. Anyway, on the S&P, up 0.4%.
Yes.
Yields are higher as well, up by 3 basis points on a 10-year, 343.91. We talked a lot about the short end, the front end of the curve, through 370, Lisa, and approaching 380 at one point in the last day or so.
Yeah, and Tom, you raised a point earlier where you were talking about how it's not just the Fed's response to these numbers in the U.S., it's globally what the response is.
I strongly feel
and we're
that.
hearing from the ECB chief economist today, who comes out and says says that inflation is still way too high and that policy is still way too accommodative. So that's what we're hearing, the latest out of the rest of the world. At 8:30 a.m., we get U.S. August PPI. Does it matter? It will matter if it comes in hotter than expected and confirms what we saw yesterday. Perhaps on the margins, if it comes in much weaker, it will confirm things for people who are coming out and saying, you guys all have it wrong. Either way, we are coming off such a high level. The bar is pretty high to really move the needle. At 10:30 a.m., EIA crude oil inventory report. This comes after that reporting that Anne-Marie helped put out there yesterday about what happens if oil prices get down too low, or to $80 a barrel, too low, I guess I'm saying in quotes, for this administration. They will come in, they will buy. How much do we actually see demand destruction starting to abate and people going in and actually using more gasoline now that prices have gotten lower? And today, this to me is a big deal. It's a huge departure from the COVID-era policies, with Chinese President Xi Jinping beginning his first trip out of the country since the pandemic. He is going to be in Central Asia. He is going to be meeting with Russian President Vladimir Putin. How much does this signal a shift that goes beyond just his personal travel schedule, John?
A dictators' convention that we'll all be watching closely.
With words.
Yeah, Wei Li, the global chief investment strategist at BlackRock, joined us now. Wei Li, I want to go straight to a quote of yours on a recession in Europe. You've been on top of that story for a while. You've pushed the same story recently, and you've asked the question, why aren't equities pricing it? And you're not alone, Wei Li. Why do you think that's the case?
Why do I think equities are pricing in not a recession? I think there is a lot of hope in markets that the innovation of corporates would eventually continue to come through, and margin would stay elevated. But in our view, actually, that is unrealistic to expect that in this environment where cost of production is going higher, labor shortage is prevalent, not just in Europe, in the US as well, where I am right now. It feels like I'm manning your studio for you today. So in that kind of environment, we expect margin to actually come under pressure, and eventually the current market consensus for earnings growth, not just in Europe, but also in the US, will have to come down to meet the reality that we are heading into a recession in Europe this year, and one in the US likely next year as well.
Wei Li, I find your note to be the grimmest note on Europe I have read. I will not mince words about it. It's very, very difficult. Does Madame Lagarde have the nominal GDP firepower, the economic animal spirit to affect the rate path you suggest? Do they have the interior structure to do higher interest rates?
I want to pick up on something that Lisa talked about, which is this idea of unreality, right? So we're in an environment shaped by supply constraint, which is very, very different from the great moderation that has been shaped by demand and spending. And in this environment, actually, the trade-off facing central banks are so much harder, the trade-off between growth and inflation. And so far, what we have heard from Madame Lagarde is perhaps some lip service to this trade-off, but not really acknowledging how costly it would be to actually bring down inflation through hiking rates, and what that means for growth and what that means for the labor market. So we believe that until central bankers acknowledge that trade-off and choose to live with inflation, we are going to be in this environment for an extended period of time where the politics of inflation will be prevalent instead of the economics of inflation, which will become clearer as we enter next year. But right now, all eyes on fighting inflation, which, based on what we saw yesterday, the core part of inflation is proving to be sticky and persistent.
Wei, a lot of people would agree with you about Europe, and you're hearing a lot of notes, or reading them, that are saying underweight Europe. It's not so clear in the U.S. It's not consistent in terms of the messaging. How far away from realistic pricing do you think we are in equities, even after what we saw yesterday?
Right now, obviously, markets are moving very, very quickly. Yesterday, very dramatic sell-off, but today bouncing back a little bit. We believe that actually more needs to be given back to properly reflect the fact that we should be looking at a earnings recession. So right now, if you look at year-to-date market pricing, we think that actually the rate path is to some extent fully reflected in equity pricing, but the fact that earnings is going to stall greatly is not yet reflected. In comparison, however, credit is pricing in a version of growth stalling, which is why in a whole portfolio context we prefer to own credit over equity. And just building on this idea of unreality, now, Lisa, you asked about the U.S. We also believe that the Fed has yet to acknowledge the very difficult trade-off between growth and inflation. We'll pay attention to the economic forecast next week, but in our assessment, actually, in order to bring inflation back down to 2% over 2 years, we could be looking at 3 million additional people out of a job, and also deep recession, 2% contraction, which is currently not being talked about. This is the sort of tough trade-off that we're looking at in this environment shaped by supply constraint, and we think that markets will wake up to that in time.
Wei Li of BlackRock. Wei, fantastic, as always. Was that the big reality check yesterday, Lisa, to get us to think about those things just a little bit more deeply?
Well, it was a reality check when it comes to the rate path. I think what Wei is talking about is kind of echoing what we've heard from Mike Wilson over at Morgan Stanley. It's the earnings recession story and how deep that will go and which sectors will experience that the most directly. And you did see that with the semiconductors, for example, yesterday, disproportionately selling off because that just sort of exacerbates the trend that you'd already seen being priced in and communicating with some of the earnings
This
reports.
conversation about a soft landing, Lisa, and maybe a short and shallow recession, does short and shallow get it done to achieve what this Fed ultimately wants to achieve? Isn't that what Wei's really speaking to right now? The Bank of England is the only real major central bank right now that's actually forecasting a recession.
Do they want to really be that person? I mean, I'm sitting here, I guess that,
do you get to choose when you make the forecast? I want to come across as a nice guy, or do you make the forecast?
Enough. A lot of people are saying that there is a soft landing scenario, but it looks like it's pretty unlikely.
Sam Stovall is going to join us from CFRA, Tom. Looking forward to that one. On this equity market bounce of 0.4%.
Well, it's important to have Sam Stovall join us here to talk about what's actually going to happen, the dynamic of revenue and critically of earnings.
Looking forward to the conversation. Yields higher by 3 basis points on your 10-year, 3.44. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. China is facing its biggest drop in oil demand in more than 3 decades. According to the International Energy Agency, Chinese demand will decline by 2.7% this year. Now, much of that is blamed on restrictions imposed as part of China's COVID-0 policy. Ukrainian troops are keeping up the pressure on retreating Russian forces. Ukraine's border guard services said the army has now retaken a town just 2 miles from Russia that was seized on the first day of the war. Russian troops have been seen withdrawing toward Moscow-controlled Crimea. Google has lost most of the first round in its fight to overturn the EU's record $4.3 billion antitrust fine. Judges upheld the vast majority of the European Commission's arguments, but they cut the fine to $4.1 billion. Google is accused of imposing unlawful restrictions on manufacturers of Android mobile devices and mobile network operators. A strike set for Friday could prevent American railroads from transporting farm products and other key goods. It could cost the U.S. economy $2 billion a day. President Biden is personally trying to break the logjam between railroads and labor unions. Labor Secretary Marty Walsh will meet with railroad and union representatives today. And Queen Elizabeth II's coffin is now at Buckingham Palace. Today, there will be a procession through London to Westminster Hall, where she will lie in state for 4 days before her funeral. Members of the public will be able to pay their respects 24 hours a day. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The stock market doesn't necessarily reflect the state of the economy, as you well know. And the economy's still strong, unemployment's low, jobs are up, manufacturing's good. So I think we're going to be fine.
We're going to be fine was the message from every single equity market bull to clients yesterday after the inflation report. That was the President of the United States. Equity futures right now positive 1/3% on the S&P 500. Yields higher by 3 basis points on a 10-year, 343.91. We're bouncing back on equities. Yields just keep pushing up. In the FX market, euro-dollar just about holding on to parity, 1.0000. Tom, that currency pair positive 1/3%.
I haven't mentioned it, John. The real yield, I did the math. I think it's 221 basis points from the bottom a number of months ago up to 100 basis points positive now.
Wow.
And that changes the decision tree for everyone out there.
And then you've got to layer QT on top of all of this.
Yes, I agree with that.
Does it take you back to late 2018 and when markets really started to fall apart, particularly in credit, and this Fed had to back away?
Don't look at me. Look at Bramall on that question.
No, it's different because inflation is a completely different story.
So
now
they
that
can't
is the
back
mandate.
away.
They can't back away. So it's actually different than 2018.
It makes you wonder why credit spreads aren't where they were.
Exactly. And Wei Li was saying that they have priced in more of a slowdown than equities, which raises a whole host of questions, in my mind anyway, because they really haven't done that much.
Here's a paragraph as we go to Michael McKee and Anne-Marie Horton as well. The 2022 railway strikes are an ongoing industrial dispute that has seen the largest instance of industrial action in the country since 1989. That would be of the United Kingdom. So true suddenly in America. Michael McKee, let me begin with you. I thought we were strike-free in America for the most part over 30, 40 years, and yet we must consider railway strikes.
Oh, we must consider them. This is a hand grenade rolled into that rosy scenario that Joe Biden was talking about yesterday, ironically, because he's the most labor-friendly president in years. But 100,000 railway workers for freight railroads, including Union Pacific, CSX, BNSF, which is Warren Buffett's railroad, Norfolk Southern, they could walk off the job starting tomorrow. And it's almost impossible to overstate the damage that would do to the U.S. economy. Most of the U.S. economy's farm products move by rail, and it's almost harvest season. And remember, yesterday, food prices went way up in the CPI. Already, one railroad, Norfolk Southern, is not accepting cars, new cars for shipment across the country as of today. They don't want cars stranded out there. And we've been short new cars, and prices have been rising. And so there is an inflation problem. There is a recession problem. This could really, really screw things up.
Anne-Marie, talk to me about the politics of this and how you expect Secretary Walsh to engage in what Mike McKee's talking about.
Well, he's going to have a big meeting this morning with both the rail carriers and the union representatives to try to get an agreement. And while Washington does seem somewhat calm, David Weston was talking about this with me yesterday, there's always these 11th hour deals, right? You wait to the last possible moment to strike a deal. The White House, at the same time, is drawing up contingency plans and looking at what emergency powers the president would have to enact to make sure that what Mike is saying, these flows of goods, could continue. One of the problems they already have, though, is that already you see certain goods, they're starting to stop. Things like ammonia, which is desperately needed for fertilizer, which also, of course, is needed to grow crops and to feed our table. Huge inflation story. It is also used in hazardous explosive products. You can't leave that idly by in a train car. So already you are seeing these companies stop some of these goods. So the impact already is there. And what they want to do is really try to warn this off. They need an agreement by Friday because politically, this is not a good look for this president less than 2 months away from the midterm elections, especially as he said he wants to be the most pro-union president ever.
Well, that's exactly where I wanted to go to build on what John was talking about, which is this is the delicacy, Anne-Marie, of the dance for this White House. And for Secretary Walsh, who has been a big labor proponent, does this pit them against the labor union? Are they going to talk about some sort of financing to try to get this through? What's the solution?
Well, it's very awkward because they want to be seen as pro-labor, but at the same time, they also need an agreement. And they need it very quickly. They need it by Friday or really today, because if you want to make sure those goods are starting to flow and they're not stopping them from loading, it's a tricky one. And you're going to see them delicately, politically in the press come down the line in the middle, but they're obviously going to be putting pressure on both sides here.
Mike, let's cut to the chase of what matters, certainly to the fools like me on the East Coast. This is about freight. It's about moving America's stuff. Does this affect the Acela? Does this affect the Northeast Corridor and passenger trains, for that matter, nationwide.
Got bad news for you, Tom. It does. Right now, Amtrak has already suspended some long-distance train service because they use freight railroads' tracks. And we've also heard from commuter rails in Northern Virginia, California. They are going to shut down if the railroads shut down. So that'll affect further the commerce in a whole lot of cities in America. So this is a pretty big deal for everybody.
Guys, thanks so much. Michael McKee, Emery Horton, thank you so much for that brief in America. I want to get a brief right now in London with John Ferro. John, let me cut to the chase. Why do the trains in Switzerland, Germany, France, why do the trains in your United Kingdom run so much better than the disgrace that is America?
I wish I had a 60-second answer to that, Tom, so we could correct everything. These short
we can get a beverage and work on this.
I don't know, but I think we've both experienced the seamless transition from one train to another in Switzerland. I was actually just reading a story here in the Metro in London about London Heathrow today. They are cancelling some flights out of respect for the Queen to ensure silence over central London.
Oh, okay, wow. They come in.
What do you make of that?
It shows you just how big of an impact
how big a deal
really
this is.
Yeah, exactly.
Yeah.
Incredible stories to start reading, sure.
Let's paint the picture of this. John, help me out here because I'm back in economy while you're up front looking out the window.
Nobody
you're coming in and you overshoot London, come around just this side of Rotterdam Circle.
You circle, and maybe circle a little bit more.
And then you turn around and you get a rock star view of London.
You hope.
Literally, am I right? Literally flying over Buckingham Palace.
That kind of direction, Tom, depends how many times you
I've never seen the view myself.
Because you know when you're coming down at 6 a.m. and then everyone's coming down at 6 a.m. and you have to keep going round and round.
Yeah, I've done that. I've enjoyed that.
London Heathrow. Anyway, that's a separate complaint.
That's your tour guide.
Perhaps getting a little bit too personal. At 9:20 Eastern Time, Lisa, can't stop laughing. 9:20 Eastern Time, that very emotional procession is going to begin. That journey from Buckingham Palace, the gates will open, and then the coffin of the Queen will be followed by the royal family, the senior royals, all the way through the Mall, up through Horse Guards Parade, through Whitehall, and then on to Westminster Hall. And we'll be following some of that for you just before the opening bell. Going into that opening bell, equity futures just about positive, but let me tell you, those gains are fading. Those gains are fading. Live from London, this is Bloomberg. The bounce fades this morning. Good morning to you. Futures just about positive by 0.2% on the S&P 500. Equities up by 7 points. Yields higher again by 4 basis points on a 10-year, 344.68. We were just above parity on euro-dollar. We give that up too. Euro-dollar still positive by about 0.25%, but things starting to develop in the last, I'd say, 30 minutes or so into the same direction we travelled just yesterday, just without the might and velocity. That was a brutal move. That's the first time I've said brutal so far this morning, Bramo.
That's the joke, because you've said it pretty much.
This hour, at least, for the last 30 minutes.
I just want to point out that if you take a look at two-year yields, they're basically at 3.8%. So they've just surged right back up to the highest levels that we've seen since 2007.
That's the poison in this market right now. It's the move at the front end. It's the move, as Tom said. Tom, you've said it a million times over the last day. The move in real yields is just so big.
Yeah, let's go through that very quickly here before our qualified guest. You take the nominal yield, the one we quote all the time, and you take out whatever inflation component you're using, and you end up with the inflation-adjusted yield, John, which is the real yield.
And that's what this Fed is trying to achieve. Get real yields up, get financial conditions tighter, get inflation back down.
Clinic now in a brief for Global Wall Street. Edward El Husseini joins us right now. He's been a huge value for us with senior interest rate strategist at Columbia Threadneedle. Thrilled he could darken the door today. Ed, I want to cut to the chase and look at what the pros look at, which is a spread market, but I want to get away from the vanilla 210 spread, the difference in yield between the 10-year and the 2-year. Which is a spread that gives you most information, giving the turmoil, the brutal moment we're in?
Yeah, I mean, to your point, perhaps one of the most important spreads right now is the steepness in the euro-dollar curve in the front end. So in other words, expectations for what the Fed will do between now and, let's say, the middle of next year. And what's been happening is we're front-loading hikes. We're raising the terminal rate, in other words, the high watermark to which the Fed will get to. And we're pricing the Fed to stay there for longer. All of those are tightening financial conditions.
Right. Zero Hedge had a Bloomberg chart, and I think it was last night, where they had a terminal rate, that rate out there somewhere, of, I believe, 4.33%. Let's not guess what that rate's going to be, but at what level does it become harmful in terms of price down, yield up?
What level does it become harmful? It's tough. I mean, the current level of yields that are priced for the front end, to your point about, let's say, 4.25% to 4.5% by the second quarter of next year, they are starting to damage the economy, no doubt, right? You can see that in the housing market most prominently. But there is a lot of damage that's in the pipeline right now that we will see hit the economy with a lag. So to the extent that that starts to materialize, we will see the front end start to stabilize over time as that long end gets to about 4.5%.
Ed, we've been talking about what we're pricing in right now. We definitely are pricing in a more hawkish Fed, as we've seen the two-year yield climb to the highest levels since late 2007. But within credit, are we seeing corporate debt price in the revenue slowdown, the profit slowdown that Whaley of BlackRock was talking about, that Mike Wilson at Morgan Stanley is talking about, and that perhaps the sell-off yesterday really represented?
Yeah, I would say there's sort of two things happening in credit. One, the underlying corporate balance sheet strength, particularly in investment-grade credit, remains very solid, despite the marginal slowdown in the economy. In the high yield space, we're starting to see, obviously on the margin, low-quality companies experiencing refinancing issues. But by and large, credit markets have behaved in a very orderly way. So to the extent that we are tightening financial conditions, credit spreads are wider across both investment-grade and high yield. It's happened in a much more orderly way than the moves we've seen, for example, in equities.
So are you seeing opportunities within the rates space? I mean, are you seeing yields get to a place where you've seen the highs, for example, or getting close to the highs in the 10-year yield? I mean, I know that that's a dangerous thing to say because every time someone says it, then it tests it the next day. But I'm wondering if we're getting to that place where you're starting to see value again in duration.
Yeah, I mean, duration's been very interesting. I think we've been early in terms of seeing value in duration. The 10-year yield has moved, plus minus 100 basis points every, 6 to 8 weeks. So there's not been a lot of stability. Interest rate volatility has been exceptionally high. But if you take a step back, what's happening here is the Fed's putting a lot of credibility in play in the front end of that curve. If we look at inflation expectations further out, they are at year-to-date lows, to Tom's point on 10-year break-evens. And as this process plays out, as inflation starts to cool, and as the economy starts to slow progressively into the middle of next year, 10-year yields at 3.5% to 4% will look exceptionally attractive.
Ed, I want to go retail on you right now. Forget about spreads, forget about Delta and all the rest of it, the hedging and such. Retail out there on radio and TV now with Bloomberg surveillance is going, wait a minute, price down, yield up, month after month. What happens if we break through to new lows on price looking at different Bloomberg total return aggregate indices? Is there like panic like equities? We've never been here. What happens when we break down to new price lows in fixed income?
Yeah, I mean, there's been significant outflows in the retail space out of fixed income, given the drawdown. To your point, the drawdown has been exceptional this year. Two pieces of good news on the horizon, right? In terms of yields increasing, we started out with 10-year yields at 50 basis points a year and a half ago. To the extent that yields rising from 50 basis point to 1% do a lot more damage than yields rising from, let's say, 3.5% to 4%. So the pace at which the drawdown's happening is decelerating. And then if you take a step back, the income component, whether it's from high-quality credit or treasuries, now is a lot more attractive. So you have a lot more cushion as a retail investor coming into the fixed income market right now.
Lisa, 78, I believe, 79. You got a monthly statement, loss. Next one, loss. Third monthly statement, loss. That was child's play compared to where we are right now. for people that own bills, notes, and bonds.
Yeah, a bear market in bonds is not something that people hear about very often when you talk about 10, 20% of a drawdown. Let's go global here and take a zoom out. There had been, before this past year, this search for yield, and the U.S. was the haven spot, and a lot of that money was coming from Japan. We heard overnight about the possibility of abandoning or not abandoning. We didn't hear any specifics whatsoever, but there are policy steps that potentially we could hear to edify the yen, to support the yen with concern of what's going on. How closely are you watching that situation with the systemic import of that currency and, frankly, the entire Japanese JGB market?
Yeah, no, it's very important, both in terms of what's happening in the European rates market and the Japanese rate market. Increases in rates there could spill back into U.S. rates, particularly the long end of the Treasury curve, no doubt. At the same time, in the grand scheme of things, the Fed strategy and the domestic inflation story here dominates by far. And so if you're a cross-market investor and you're looking at U.S. rates, European rates, and Japanese rates, U.S. rates, in my mind, continue to offer the best value on a risk-adjusted basis right now.
Ed, very quickly, you're not doing the Fed dance, but let's do it right now. What do you expect next week?
No doubt the Fed signaling that there is more work to be done. So to the extent that they had a terminal rate of, I think the median terminal rate was 3 3/4, that probably moves higher, let's say 4 1/4 to 4.5% by the end of 23. And very likely they start to incorporate a slower economy, so higher unemployment into their forecast.
Ed, thank you. All the guests going into New York, into the studio.
I know,
just when we're not there. Have you noticed that?
You think it's a coincidence?
I've got no idea.
We hear they're not around.
Tom's not there. Let's go.
You'd be on your phone anyway, ignoring everyone.
That's true.
Ed Al-Husseini of Columbia Threadneedle. Ed, thank you, sir. As always, you're trying to be very diplomatic around the BOJ story.
You didn't agree with it.
No.
You just pushed me around.
The stage is yours to tell us what you really think.
They say they're trying to jawbone the yen to a stronger place. They're saying they will intervene if things get out of hand. They aren't going to warn. They aren't going to give details, but they're going to do it. What are they going to do? Abandon the peg?
Are they out of hand right now?
I mean, I just am wondering, do they have any sense? Right, exactly. At what point, what's the threshold for them getting involved? Are they just trying to throw this out there to scare people away from shorting yen too aggressively?
They keep saying like almost there's some kind of disorderly dislocation in the FX market.
It has been for a while.
Yet it's so highly intuitive, we can all explain it. Everyone else is hiking by a lot, and the Bank of Japan is not. And they're also doing something in addition to that. They're capping 10-year yields. I believe the upper band is 25 basis points on a 10-year.
So
no one else is doing that.
Right. So are they going to abandon that? And if that's the case, what happens to the Japanese bond market? How quickly does it reprice? Who is going to be there in their pricing, considering how stagnant it's been, that it has not been a market for as long as it has?
Do you know what I'm taking abuse for? Heathrow. People writing in to tell me Heathrow is the worst airport.
Oh, I disagree. The taxes are the worst.
And you're responsible
what
for
you pay in fees?
Why I would take that personally? Do you know what I said back?
Oh, I love it.
I think they've misspelled JFK.
I love it. I love it.
On departures, JFK.
Well, now we can beat up on them because LaGuardia looks nice.
Hey, LaGuardia looks good.
It looks really good.
I agree. LaGuardia looks better.
Yeah, okay, I'll go there. But I'm sorry, it's like the trains in Europe. They just somehow do it better. Can I just stay within the wonderful time we're having here amid the funeral and the somberness of the Queen's moment? John, the Vindaloo that you and I had last night, that fiery red, it was... I had never tasted anything like that.
Where did you go for Indian?
Down by the river.
Okay.
You know.
Was it good?
I couldn't taste it. It was so damn spicy.
It was so hot?
Yeah, I don't do that.
Okay. Would you like me to recommend somewhere for you?
Yeah, you could. You know, you're going to do some hedge fund alley thing.
Something high end for you would be something like Jamavar in Mayfair. I think that might be your kind of thing.
It's fine.
Lisa and I'll go somewhere else.
But we're trying the different Vindaloos.
Okay. Michelle Meyer's going to join us very shortly from MasterCard. Just things to say.
Important conversation, seriously.
Important things.
Yeah.
On the housing market as well.
Yes.
Given where rates have gone to, just wow. Equities positive 0.2%, live from London. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. European Commission President Ursula von der Leyen laid out plans to raise $140 billion to rein in the biggest energy crisis in decades. The funds would come from capping revenue from low-cost power producers. Von der Leyen's proposal is just the start of what's likely to be fractions of discussions among EU nations. In Germany, the government is open to the historic step of fully nationalizing the country's biggest natural gas importer. Chancellor Olaf Scholz's administration is ready to inject more capital into Uniper and increase its stake to above 50%. Uniper lost $12 billion in the first half of the year. The Biden administration is considering whether to replenish the strategic petroleum reserve when oil goes below $80 a barrel. Just 2 years ago, Democrats blocked former President Trump from filling the reserve at a fraction of that price. Senate Democratic leader Chuck Schumer called the Trump proposal a bailout for big oil that cost the U.S. billions in potential profits. U.S. job growth is expected to slow this decade as the labor force ages. That's according to the latest projections from the Bureau of Labor Statistics. The report shows the 0.5% projected annual growth rate is half the pace recorded in the decade through 2021. About 9% of workers, they're expected to be at least 65 years old, roughly triple the share 3 decades earlier. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Bring inflation back down to 2% over 2 years. We could be looking at 3 million additional people out of a job, and also deep recession, 2% contraction, which is currently not being talked about. This is the sort of tough trade-off that we're looking at in this environment shaped by supply constraint.
I don't think I've ever heard Wei Li that bearish. That was Wei Li, the global chief investment strategist at BlackRock, about 50 minutes ago. Equity futures this morning fading. Not much of a bounce now, up a little more than 1/10% on the S&P 500 after a move lower yesterday, the biggest one-day move lower going all the way back to June 2020 on the S&P. Yields are higher by 4 or 5 basis points on a 10-year to 345.27. Talked a lot about a 2-year, 3.370. Did we breach 380, Lisa?
We breached 380. We're
there we go.
Almost to 381 at this point.
I cannot keep up. Cannot keep up, and that's why we're seeing this equity market, Tom, roll over.
And we're going to watch FX as a litmus paper of the system here, and to see sterling go down to a 114.57 to breach that. Weaker sterling would be something we're not there yet. Every day, every year, every week, surveillance is buried with hundreds, truly hundreds of books. And then there's one that trots across, Blas Farchi, and you go, yeah. And it's on oil, except Javier Blas made an incredible splash with his book, his effort here on the trading of oil worldwide. We're honored that we could join him in his London this morning. The theme of this trip on hydrocarbons is no one's willing to pay the cost, the social cost of where Europe is, where America is, for that matter, where Asia is. When do we start paying the cost of Mr. Putin's war?
Well, we are beginning to start the paying now. Businesses in Europe have been paying it for several months already because they don't have price caps as households has in many European countries. So businesses, particularly small and medium enterprises, have been fully exposed to very high electricity and gas prices. And that's why we are seeing a lot of companies actually reducing production or shutting down in countries like Germany. And now governments are going to have to start paying those costs because they're going to have to bail out not just families, they're going to have to bail out entire economies because at current electricity prices, nothing really works in countries like Germany.
You've seen the plans come from respective countries and the European Commission as well. Do you think they've confronted reality just yet, Javier, based on what you've heard?
They're beginning to confront reality, but there is this sense in Europe that they are doing a lot and that the worst is behind. And I keep saying to myself, we are only started to doing enough to keep things rolling. And I don't know if the worst is over. I have absolutely no insight whatsoever on what's in Putin's brain. But I know one thing, and you could see it behind us. It's kind of sunshine today in London, and it's a very pleasant day of September. We are not in winter yet. We have very difficult months ahead. I really will say the worst is over. when we turn at mid-January. But to say the worst is over in mid-September, no way.
Well, I think we all wanted to ask a question about that. Is the worst of it just about the severity of this winter, or about the prospect, the duration of this story could be longer than just a single year?
I think it's a combination of both, but one thing that is very important is the duration. A lot of people in the industry, when I talk to CEOs in Europe, a lot of people plan for a few weeks, perhaps a couple of months of high prices. We are on month number 7, and probably we have another 6 in front of us through the winter of very high prices. And the potential that you are mentioning, even if prices come down a bit, someone reminded me, I tweeted a year ago, yesterday precisely, that German electricity prices for the 1 year ahead have surpassed the 100 euros per megawatt hour.
Where are they now?
And that was like amazing news. That was an all-time high, and no one could really think 100 euros. We're at 500 now.
Wow.
Even if we come down, we are not going to go back to what one day was normal. And also very important, that 100 euros was already double what it was normal before that. We are 10 times normal.
There's a question about how to support the build-out, the quick build-out of the resources, and this speaks to John's question about the length of the crisis, whether it's going to be a next winter or the winter after. We see in the United Kingdom an aversion to the windfall tax, an aversion to taking money from the big oil companies for fear of, and the big gas companies for fear of cannibalizing from their investment. The European Union is taking a different approach. Which is right?
Well, my politics will say that probably the European Union is more right than the UK. But at the end of the day, everyone is going to tax somehow to pay for this. It's a question of who you tax, the companies or the families and the whole economy. But the UK is going to spend 5% of the GDP over the next few months supporting the economy through the crisis. That's going to be borrowing money, and that's going to have to be paid through taxes in the future. It's a question of whether you tax everyone or you tax particularly some of the companies that they're benefiting from the high prices.
So if you try to crimp demand, if you go at it from that side, which I know a number of countries have started to do, how much activity has to get taken offline? How much production of factories has to be put aside and delayed?
The European Union has put some numbers. We need to reduce consumption of electricity in particular by 10, perhaps 15% at peak time. So we need to reduce activity by probably 10-15%. And that at times, at some people, will not sound like a lot, but that's reducing the GDP activity hugely. I don't know if that is even possible. And Europe is going to do, or the European Union is going to do a very, and the UK, they're going to do a very interesting experiment. They're going to have to do that reduction in demand without the market signaling for that reduction in demand. It's going to be governments who are going to have to mandate a reduction. And we are going to see every company, every lobby telling the government, my sector is more important than everyone else.
Sure.
So spare mine and reduce the demand from that one, that other one. I don't know how they're going to do it.
Javier, just quickly, what do you make of Germany's approach to this crisis, with Germany at the epicenter of it, compared to Germany's approach to the last crisis in Europe in, say, 2010, 11, 12? With Germany on the outside, looking towards the periphery?
I'm just going to have to, for one moment, forget that I come from one of the southern countries. I'm going to try my best. But putting aside that, I think that Germany has been very slow. The European Union have been very slow in recognizing the magnitude of the problem. People were warning them a year ago, 6 months ago, 2 months ago what's coming. How is it possible that only today strong measures have been announced, and these measures are not going to be approved for another 2 or 3 weeks? That, to me, is mesmerizing.
This is out of character, because you're not diplomatic in your column at all. It's been very diplomatic about this situation now.
Yeah, the columns have been really forceful. Very quickly here. Your book is about trading. Trading is about every once in a while there's tail risk and loss. I think there's an immense quiet about the commodity risk to Wall Street firms worldwide and the independent firms you look at on their trading risks right now. Are they exposed through leverage?
They are exposed to leverage. They are exposed because the market is moving a lot. But so far, what we are seeing is that they are doing fantastically well. Some companies have made in 6 months what they usually made in a year. This is a fantastic situation for the independent commodity traders. They are making.
What about major Wall Street firms?
Wall Street firms also, they are taking risk. But so far, they have been on the right side of the risk, and they are making a lot of money.
Javier Blas, it's good to see you, buddy. Been too long. Have a blast of
Thank
Bloomberg Opinion. Coming up, Sam Stovall, Chief Investment Strategist at CFRA, on an equity market rally, a bounce that fades pretty quickly. I can tell you we're negative now. We're down a tenth of 1% on S&P 500 futures. From London, this is Bloomberg.
The main feature of the U.S. economy right now is that it's doing better than anybody thought it would be doing now.
We all hope for a soft landing. Certainly, I would hope that's what the economy can achieve. There's a possibility of achieving that. You're going to hear Fed officials that emphasize that possibility.
The Fed wants to see not just one print lower, they want to see 2, 3, maybe 4 prints lower.
We do see risks that the Fed overdoes it. We do see risks that there's a recession next year.
75 obviously is on the table, I think, in November.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
There goes the bounce, live from London for our audience worldwide. Good afternoon, good afternoon. This is Bloomberg Surveillance, live on TV and radio, alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equities down and down hard in yesterday's session. We were looking for a bounce this Wednesday morning. Tom, that bounce fades pretty quickly.
Yeah, it faded, John, and it's the way it's faded. As Lisa mentioned in the break, it is correlated, but I would note sticking out like a sore thumb is the 10-year real yield out to a new high level, 1.01. Positive yield. That is a change for everybody listening and watching on Bloomberg.
Let's take it from 10s and bring it into 2s. Lisa, we thought the headline was going through 370, and then we just made another one.
Yeah, I'm just watching this because honestly, this has been the direction of stocks, just in the opposite direction. If you take a look at 2-year yields, they have climbed now solidly through 3.8%. and keep climbing. The pace of move has been jaw-dropping. The pace of resetting the understanding of what the Fed is going to do has shifted quite significantly.
That CPI print 24 hours or so ago has just disrupted the whole narrative around this step down from 75 basis point hikes to 50 to 25. Every single note I read from everybody raised the same question. Andrew Hollenhorst, the city's been on top of this more than most. He's looking for 75 next week and the potential for another 75 in November from the Fed. It raises a lot of questions about how much more work they have to do, and more importantly, for risk assets, how much more damage that needs to be done to the economy to get inflation lower.
We make fun of this whole good news is bad news kind of conundrum. But really what this means is the more momentum there is in people spending, the more ability to withstand higher prices and to sustain them even higher. It causes the Fed to have to really slam on the brakes that much more dramatically, and that's the problem.
John, I want to push against the gloom. An announcement moments ago about what you're going to see from well-run corporations. Comcast, I believe they're in the television business as well, with a share buyback authorization of $20 billion. And John, this is the economic challenge, the grimness, as you mentioned, the brutal moment we're in, and corporations looking at persistent revenue, persistent cash flow. Where do we invest? We're not sure. Let's buy back our shares.
How much business will actually get done? You've seen the guidance we're getting from the banks going into quarterly earnings season. They're basically telling you investment banking revenue not great at all. Deal making isn't happening in a big way.
Yeah, what JP Morgan said, it was down 50%. Deal making revenues at a time when you're not seeing.
Does that mean we're not going to do the SPAC report anymore?
I think the SPAC report's been iced for a while. But partly to that. To your point, Tom, you are seeing companies buy back their shares. There isn't necessarily the level of gloom in corporate America that matches the gloom elsewhere. But do they have to get gloomier for the Fed to achieve their mandate? I think that's the question.
Can I just say how proud I am of the team that we never did the SPAC stuff?
We just, point taken,
you know,
yes.
Whenever you see a celebrity on TV promoting some kind of financial instrument,
run.
Just kind of run. You know, we get the same pitches from the same firms. We make a big effort not to make it happen. Just going to throw that out there and then quickly switch to the price section. Equity futures on the S&P down about a tenth of 1%.
I don't think you're going to be able to get through JFK.
We've all got issues. I've got things to say. Okay, yields up by 5 basis points. It's Englewood. They won't let me over the bridge now, Tom. That's it. 346 on a 10-year. on a 10-year in America. It's the 2-year we're so focused on, Lisa, from 360 to 370 and now out through 380.
So where are we headed, right? I mean, do we stay at 4% if that's where the Fed says they're going to go? And what does that do to earnings estimates? And that's really the question for a lot of stocks.
Just what a move. Sam Stovall, happy to say, joins us now, Chief Investment Strategist at CFRA. Sam, can we just start with the big drawdown? Can we call it that yesterday, the aggressive sell-off? Did you pick up the pieces this morning, Sam? How do you approach a sell-off like the one we had yesterday?
Well, I would approach it the way Tom seems to be approaching it. That is, when life gives you lemons, make whiskey sours. So basically, you look to history that, you know, history tells us that whenever we have had a 4% one-day decline, that we usually see a bounce of about 1% the day after. That's happened about 2 out of every 3 times. But then we sort of trade sideways for the next week as well as the next month before resuming an uptrend 3 months down the road. So basically, you know, I think investors just have to hold on to their hats right now.
Sam, I've been dying to talk to you about a concept I heard maybe 10 days ago, which is a lot of good ideas out there in common stocks, but you can't get scale. You can't buy a countable number of stocks. Do you at CFRA find that you've got a number of good ideas and then it's hard to find other good ideas?
Well, I think what you're finding is that as time goes on, you find that there are fewer and fewer companies on which you have solid conviction, because what our analysts do is they're looking 6 to 12 months down the road. They're not really looking for the next couple of weeks. And so, yeah, they take a look at the change in economic projections, in earnings forecasts, look also at momentum, and sometimes that list tends to get trimmed as a result. But we still have a solid count of stocks that we regard as being 5-star or strong buys.
Sam, how do you reject this idea that we're going to see an earnings decline that has not yet been priced in? This is what Wei Li of BlackRock was saying, and this is what Mike Wilson of Morgan Stanley has put out there, that basically what the bond market is reflecting is work that the Fed is going to do that will essentially crimp the activity of a lot of companies.
Well, I think it's a logical assumption that that's going to happen. Traditionally, in bear markets associated with recessions since World War II, we've seen a 1/3 trimming of the PE ratios. But since the market tends to anticipate the end of recessions by almost 2 full quarters, we have to, in a sense, wait 2 more quarters into the bull market before we get a trough in earnings. Right now, we've already seen reductions in estimates. Q3 earnings are now expected to be up 4.2%, but on June 30th, they were expected to be higher by 10.5%. In terms of 2022 and 23 estimates, now we're looking at 6.8% for this year versus 8.9 at the end of June, and next year 7.4% growth versus 8.8. So we're already seeing a reduction in forecasts.
Sam, I'd love to squeeze this in, just a little bit more of a sector focus as Lisa digs a bit deeper. Financials. It was a big call at the start of the year. Yields are going up, rates are climbing, get into the banks. Hasn't worked out. Energy now in focus for a lot of people. This Fed is set to crush growth. That's the fear that a lot of people have if they're going to carry on hiking interest rates by 75, 75, 75. Do I want to be long energy? Do I want to be long financials, given the expectations we've got off the back of that CPI report?
Well, historically, what you find is that consumer discretionary, technology, and financials are underperformers in a hefty inflationary environment, which is what we saw back in the 1970s. We are looking at financials that are trading at a slight discount to their long-term PE ratio, so about 5% discount, whereas energy is trading at a 55% discount to its average PE over the last 20 plus years. So I would tend to say things are done more on a relative basis. And right now, on a relative basis, investors are gravitating toward the defensive consumer staples, utilities, as well as the inflation hedges of energy and, to a lesser extent, materials.
Sam Stovall, thank you, sir, CFRA. The other one we've heard recently as well, Lisa, is the small caps off the back of the concerns around the FX story and the weakness abroad.
That basically the domestic strength is going to uphold some of the stocks that have gotten most beaten up until now. I think that that's also the reason why it's a valuation story. If you read Lori Calvasino over at RBC basically saying they've already seen so much pain, perhaps there's some value.
What did Marcus Ashworth say yesterday about foreign central banks after that print? We literally got the inflation print, quickly shifted towards talking about the Federal Reserve and the market fallout. And then, Tom, Marcus Ashworth sat in that seat and he said, this is the worst news for other central banks and the rest of the world.
I agree. Well, the rest of the world's a key thing here. I'm enough old school where I'm worried about Ecuador, I'm worried about 1992 of Mexico and any number of other items of the past. There is a certitude now that EM is different this time. I don't buy it for a minute. I check every morning, Thai baht, Philippine peso, all the rest of it, and you never know where it's going to be. You can think as hard as you want, and you never get it right about which is going to snap.
Tom, how are you thinking about how much work those central banks in EM have already done to hike interest rates and try and stabilize the situation they've got domestically?
Well, they don't have a dual mandate. They've got a formal mandate, and the formal mandate, let's take Indonesia, is the people of Indonesia, a ginormous nation, odd OPEC energy in betweenness there. And I'm sorry, mostly it's a social mandate that we don't hear from the Western banks.
You've got the debt issues on the one hand, and then folded into that, you've got the FX dynamic as well. And that's really what Marcus was speaking to yesterday. Not just an EM problem. Don't know if you want to call that an EM central bank around the corner on Threadneedle Street. I'll allow you to do that. Governor Bailey's a little bit too close this week for us to go. Might avoid that one just in case I see him as I walk out the door. It's a conversation I don't want to have, but other people are having it.
Well, and the question is whether it's the Fed's world and they're just living in it and they have no say, really, even if they do raise rates sufficient to match the Fed. And that's certainly what we've been seeing in the currency pairs.
Tom, what's coming up next? Glenn Youngkin, Republican from Virginia. What do you want to discuss with Glenn?
The politics of America. We had these 3 primaries yesterday, New Hampshire and others, and now what for his Republican Party?
Do you want to squeeze some carried interest loophole stuff in there?
I was going to say, we'll talk private equity. I'm not going to, but it would be interesting.
Equities down a 10th from London. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. China is facing its biggest drop in oil demand in more than 3 decades. According to the International Energy Agency, Chinese demand will decline by 2.7% this year. Now, much of that is blamed on restrictions imposed as part of China's COVID-0 policy. Ukrainian troops are keeping pressure up on retreating Russian forces. Ukraine's border guard services said the army has now retaken a town just 2 miles from Russia that was seized on the first day of the war. Russian troops have been seen withdrawing toward Moscow-controlled Crimea. A strike set for Friday could prevent American railroads from transporting farm products and other key goods, and it could cost the U.S. economy $2 billion a day. President Biden is personally trying to break the logjam between railroads and labor unions. Labor Secretary Marty Walsh will meet with railroad and union representatives today. And Google has lost most of the first round in its fight to overturn the EU's record $4.3 billion antitrust fine. Judges upheld the vast majority of the European Commission's arguments, but they cut the fine to $4.1 billion. Google is accused of imposing unlawful restrictions on manufacturers of Android mobile devices and mobile network operators. Hong Kong will quit moving travelers with COVID to isolation hotels or quarantine camps. Instead, they'll be allowed to remain in designated quarantine hotels. That marks another easing in the city's travel policy. The move comes as Hong Kong prepares for several high-profile events, including a summit for global bankers and an international rugby tournament. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
If there's any doubt at all about 75, they're definitely going 75. We thought they would be stepping it back to November, to 50 in November. And at this point, you would say 75 is certainly going to be on the table there in November.
And maybe beyond. That was Jay Bryson, the chief economist at Wells Fargo. If you were looking for a bounce this morning, I think we're all looking for a bounce after the losses of yesterday. You're not getting one. It's very small. Briefly negative in the last 30 minutes or so. Right now positive, about 0.1% on the S&P 500, up by 2 or 3 points, only up by 2 or 3 points. Aggressive losses yesterday, the biggest one-day loss, as I've said repeatedly through this morning, and many others have as well. The biggest one-day loss going back to June 2020. Yields are so much higher. Over the last few months, we're up 5 basis points on a 10-year to 346.24. I said coming into this week, we've had 6 consecutive weeks of 10-year yields climbing. It's not just the 10-year, it's the 2-year as well. Lisa, just quickly, where are we on a 2-year? 380?
We were at 380. We're now 381.
381.
Looking at just this incredible rise and then the correlated and commensurate drop in the S&P and the NASDAQ.
TK, what a move that's been, 380 plus.
Continue to watch it here this morning, and of course data dependent, but certainly watching foreign exchange as an international measure of where we are right now. And this is the most interesting time to speak to the gentleman from Rice University with mechanical engineering as a background. He went on to engineer all sorts of efforts in private equity and venture capital. He's the governor, the Republican from Virginia, Glenn Youngkin, and we're thrilled the governor could join us this morning. Governor, I cannot think of a time to speak to you with someone as pro-business, pro-innovation, dealing with a Republican Party that wants to bomb Rob Portman and the rest back to an anti-business time. How anti-business, anti-Youngkin is your Republican Party?
Well, I don't think the Republican Party is anti-business. And in fact, Republican governors all over the country have been leading the recovery coming out of the pandemic. And that's exactly what we've been doing in Virginia. We've got taxes down. We're open for business. We're seeing great announcements from companies. We have a lot of open jobs. And that's one of our biggest challenges, is getting people back to work. I am really concerned about the inflationary policies that we see coming out of the Biden administration. And Tom, we see the ramifications of that yesterday, which is anybody who thought that this was going to be short-lived has been shaken, because what we're seeing is the persistent result of bad policies, inflationary policies, with grocery prices up, fuel prices up, and Virginians and Americans feeling it in their wallet, and they're having to make compromises as a result.
We have iconic American companies moving, for instance, from Chicago to Greater Washington, D.C., translated Virginia. We've got entrepreneurial companies such as your announcement today on an innovative company, and on a wage basis, they're competing with Amazon, who's lifting compensation for drivers in hundreds of thousands of their employees. Is there a wage spiral in Virginia?
Well, there is a real wage inflation challenge. These wages are growing, but they're not growing as fast as inflation and the cost of living. I'm really excited about these new companies that are coming, like Plenty Unlimited, that we're announcing today, that is going to build the largest indoor growing facility in the world. And we're going to see them right here in Virginia. They're going to compete for talent. This is why we have to get people back into the labor force. We've seen labor participation drop substantially in Virginia. We were up near 67% prior to the pandemic. And unfortunately, we dropped and we're in the 63.5%-ish now. We got to get people back to work. These great jobs, these next generation kinds of opportunities will pull people back into the workforce, but we've got to stop all of the underpinnings that have encouraged them to stay home and out of the workforce and get them back to work.
Governor, this indoor vertical farming company and the indoor vertical farm that you're espousing really speaks to an agenda more commonly associated with the Democrats in terms of trying to make things greener, make things more modern with respect to the carbon footprint. Do you find yourself bumping up against that stereotype when trying to have a more modern approach that brings in more young workers?
Well, not really. I mean, agriculture is Virginia's largest private industry, and technology is one of our fastest growing sectors. And so to bring agriculture and technology together in the Commonwealth of Virginia makes perfect sense. And in fact, we have absolutely become the hub. With today's announcement with Plenty, which is going to build a $300 million facility right outside of Richmond, 300 new jobs, and our announcement 2 days ago with AeroFarm, we will have the first and second largest indoor growing facilities in Virginia. And yesterday we announced another company, Beanstalk, expanding their facilities. So we're bringing together our agriculture roots, our technology future, and forging the way for an industry of the future. Ag tech uses far less natural resources, has higher yields, and a great product. And I just think this is part of the future of agriculture. It's happening right here in Virginia.
Just real quick, Governor, I remember speaking with you when you had your private sector hat on about infrastructure and plans that you were looking for. And I'm wondering now that you're in the public sector, if you've been surprised by the partisanship that prevents certain things from happening, or have you been surprised in the other way?
Well, I do believe that investing in infrastructure broadly is critically important to facilitate growth. I mean, we're seeing capacity issues across our infrastructure. I mean, we're still rated a D as a nation. We got to address this. And so we're doing it in Virginia. We moved up substantially in the rankings at infrastructure. Our port is being deepened and widened. Our road infrastructure is being improved. Our connectivity and broadband is taking a huge step forward. And this is the kind of progress that we must make. We're doing it both with government-led things, but more importantly, with public-private partnerships. And I think investing in infrastructure will continue to be one of the great challenges and the great opportunities for Virginia and the nation.
Lisa, is that one step closer to asking about carried interest? Is that what you wanted to do with the governor next?
We could have gone to carried interest, but we're out of time. So you're in luck.
Governor, I know we had some technical problems to start
much.
the interview, so we have run out of time, sir. But next time we'd love a longer conversation. Governor Glenn Youngkin there of Virginia. Governor, thank you. Great to catch up with him.
Yeah, he's a really interesting person. And speaking to him when he was at Carlisle, he was really big on investing in infrastructure.
We didn't have time to get this in, but I think an important conversation with somebody straight talking like Youngkin is okay, but can you find common ground with Democrats with the American disgrace, which is child care? He wants, the usual Republican chit-chat about get people back to work. And yet we're living in the medieval age. It's like Westminster Hall. We're living in the medieval age of child care in America.
I think that it's a big issue. You want me to comment on that one?
No, I just
honestly,
think it's tangible.
He's been very vocal about education.
We're leaving that there. Future's up, a tenth of 1%. Didn't know where it was going. Live from London.
It's with Tom Keene. What do you want?
This is Bloomberg. Lisa said it's PPI Wednesday, so we're getting some PPI data in a couple of seconds. Futures into that, up 0.2% on the S&P.
58.
Futures just about pushing high. Yields higher as well by 5 basis points. With the data, here's Mike McKee.
54.
The numbers are just coming across for producer prices. Final demand on a month-over-month basis falls by 0.1%. And that was what was forecast. The core, though, rises by 0.4. That's more than the 0.3 that was estimated. That's ex-food and energy. With PPI, you also take out trade services, which is basically an equivalent of retailer margins, and you have a 0.2% rise, same as last month, same as forecast. So this leaves us with a final demand year over year at 8.7%. That's down from 9.8%. The core 7.3 down from 7.6, and the core with trade services 5.6 from 5.8. So some significant changes for the better on the PPI side, on the producer price side, contrasting with what we saw on the side of the consumer price index. So maybe everybody can get a little happier today.
Maybe just a little bit, or perhaps not quite. Mike McKee, thank you. Equity futures pushed just a little bit higher, up by 0.2% on the S&P 500. Yield still higher by 5 or 6 basis points, 346.43 on a 10-year. The 2-year still through 380, just about, Bramo. Lisa said it a few hours ago when we opened the show. Basically, this data point was about whether it confirmed your fears about yesterday, and if it didn't, you just ignore it and look ahead to the Fed next week.
I would agree with that. That's basically...
That's what you said 2 hours ago, and that seems to be how the market's moving.
I stand by it.
Should we start the countdown clock to retail sales tomorrow?
Would you like to do that?
23 hours, 58 minutes.
Let's go.
14 seconds.
You should go in the line that's circulating London right now to go and see the Queen, and Just count down
They
to
should.
retail sales. They'll have no idea what you're talking about.
I could stay there for 3 or 4 days. Seriously, a huge queue to see the Queen. We'll bring that to you in the next hour.
It's just crazy.
Yeah, this is really history being made, folks. So please stay with us in the next hour through the weekend and into Monday as well. Right now, and this is really an honor because I can give you a story about how economists become stars. Michelle Meyer is with MasterCard Economics Institute, but far more, one day, a girl fell out of Boston University and everybody stopped and said, wow, does she know housing? Michelle Meyer joins us now after years at Bank of America and truly expert on your next mortgage and rent payment. Michelle, let me cut to the chase. How bad is it? How bad and how persistent will the housing inflation be?
Well, thank you, Tom, for that wonderful intro. You know, I think the big challenge for the housing market right now is simply affordability, and that comes from two factors. One is that home prices increased at an extraordinary rate across the country over the last 2 years, running in double-digit rates for the major metropolitan areas. By our metrics, and we looked at home prices relative to income growth across all of those really specific metro areas, about 65% of the country is considered overvalued. So you have that coupled now with this extraordinary increase of mortgage rates, and that has created a huge shock to the housing market. So as you know, home sales have been falling steadily since the beginning of the year.
Right, multifamily to the rescue. That's what always happens in the cycle. Can multifamily come to the rescue in Nashville or Denver, never to the rescue in New York, but is multifamily, are we getting more units?
We are. We certainly are. I mean, if you look at housing starts, they're still running above what you would consider a break-even rate, particularly for multifamily. And remember the lags with multifamily as well. It takes about a year from the beginning of the project to completion, on average, once the construction starts. So, you know, you had a lot of projects that were ongoing. The development was happening, and now you're starting to see those completions. So you're starting to see those projects enter the market in a bigger way. So you still have supply hitting the market, particularly in the multifamily space. And that should help because you can have some conversion from owning to renting, given the affordability strains in the housing market. But look at owner's equivalent rent in yesterday's report in CPI. That is accelerating further. So there's still rental pressures as well, which further strains affordability across all housing.
What can rate hikes do about that? What can rate hikes do about that rental price pressure we're seeing build?
Well, I would argue that that transmission from monetary policy is quite apparent in the housing market right now and will be increasingly in the rental market as well. You know, these are interest-sensitive sectors. And the fact that the Fed is increasing as rapidly as they have, and you'd argue for reasons that are quite clear to contain prices and inflation, that increase in interest rates has slowed down demand of housing. And in turn, it will put that type of downward pressure on home prices as well, on home price appreciation, which then spills into rental inflation. But that all takes time. It is not immediate. But I would argue it's already underway, that transmission.
Well, at least on the housing price side, but on the rental issue, I just want to pick up John's right to bring up the fact that rents are still climbing and faster than people had previously expected, at least based on the CPI report from yesterday. And there's an argument that the higher prices go on houses, the more people are forced to rent, the less affordable it goes, especially given the high mortgage rates. Where is this potential for an overshoot at the same time that the people who are least able to handle inflation are feeling all the more pain?
Yeah, I mean, look, these are certainly some of the challenges here in terms of finding that ultimate equilibrium in the economy after creating, you know, some real imbalances in terms of excess stimulus. And I think, you know, the adjustment is happening, but it's not complete. And in the interim, yes, you've seen this, you know, some push into to renting, which is increasing demand for rentals when there's still some, you know, lag in terms of getting all that supply into the market. But it will come. And frankly, you know, one of the ways it will come in terms of normalizing inflation, normalizing particularly rental inflation, is through the demand side. in the sense of weakening the broader economy, particularly the labor market. You have a bit of an income shock, and then naturally you start to see that feed through. And that's what Fed Chair Powell, I think, has been saying quite clearly, which is that they are keenly focused on price stability and reducing inflation. And that does mean, sacrificing some real growth.
But this really leads to the question of how much pain needs to be inflicted on this economy, or how much pain will be inflicted on this economy based on the rate hiking cycle being priced into the market in a way that we are not anticipating because of that lag time, because we're not seeing it yet in some of the metrics. What's your sense of how likely or unlikely a hard landing, I hate using that, but a recession that's somewhat significant is, given the report that we got yesterday on CPI?
Well, I think the report yesterday showed two things. One is that you are seeing relief on the supply side in that, we've seen a drop in energy prices. We're starting to see some easing of goods inflation and more should come given what you've seen from container costs coming down, supply chain issues easing. But the demand side, there's still a lot of inflation there, and the services economy is feeling that. So for the Fed, that has a lot more control over the demand side, it does give them that type of, push to continue to raise interest rates to cool down the economy. And Lisa, to your point, it is taking time because the starting point was really high. As we've been talking about, as I'm talking to you all for the last few months, the consumer's healthy. There's strong balance sheets. Right. The consumer's still out there spending, and they're navigating this inflation environment.
Okay, Michelle, you've been brilliant on that. And of course, you've got all the resources of MasterCard to figure that out. Jim Glassman at JP Morgan is pushing against the gloom like no one I've ever seen in the decades he's done this. Help us with the Glassman-Meyer consumer. How boomy is the consumer right now?
Look, from our data, we're looking at our spending pulse data for the month of August. There was an acceleration in the year-over-year growth rate of consumer spending. And that's, even controlling for these movements in gas and oil and autos, et cetera. So like the underlying demand, that did accelerate. So we'll see what the retail sales report shows tomorrow. But, it seems like we're setting up.
Retail Thursday.
Retail Thursday.
Michelle,
we'll give her credit for it.
Michelle knows it's Retail Thursday.
It's Retail Thursday.
It's MasterCard.
I think it's so important. This is a brutal reality and a brutal fact. James Glassman of JP Morgan and Michelle Meyer over at MasterCard is saying all of this continuum we talk about, the consumer, every seat on the airplane is taken.
Absolutely.
There's boom.
So let's say that's true. And a lot of people are on board with that view. What they're saying, though, Tom, ultimately is that because things are resilient, the Fed needs to do more. Northman Trader out on Twitter, an account I know you love, he said this: the Fed will break it until we make it. Think about that. Yes, we can talk about the same thing at the same time. The two issues, Tom. You've got a resilient economy, but also that the Fed needs to break some stuff to get inflation down.
Well, the more resilient the economy, the higher inflation will remain unless there's some sort of exogenous event to bring it down. And
some
I think
supply side miraculous story that delivers that soft landing, and we all hope for that.
Right, exactly, which is the reason why there is a narrow path to a soft landing, but it's the reason why people are getting bearish, because things are so resilient. Things are so good for the consumer.
And that's why we're seeing the 2-year yield through 380.
Yeah, which is just sort of shocking.
Onto retail sales.
Actually, just dipped right lower.
The equity market's got to digest that. It's back to normal.
Yeah, they're all going to get back to normal, and we're all going to survive.
Thanks, Tom.
That's my,
Is that like...
I'll send you the invoice.
That seems to be the speech from the president yesterday.
No, the speech from the president yesterday was he looked foolish because he did not address the immediate inflation report. He could have scored major points by being presidentially optimistic and note the inflation that's crushing a huge part of America.
To him, isn't that his comms team? What are they doing? What were they thinking about
having
a concert-type celebration of the Inflation Reduction Act on a morning like that?
This is a delicate moment, and he's actually done better in the polls over the past few months because of gasoline prices, and now it gets a little trickier.
379.86 on a 2-year. Coming up, as we count you down to the opening bell, Oksana Aronoff of JP Morgan Asset Management, looking forward to that. Zach Griffiths
corn's under $7 a bushel.
Sites, and Samir Samana is joining us from Wells as well. Where are you going with that?
I'm not. I think it's there. The Dow's up 52. Okay. Life goes on.
Do you want to take a break? No? Okay, we'll take one. From London, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. European Commission President Ursula von der Leyen laid out plans to raise $140 billion to rein in the biggest energy crisis in decades. The funds would come from capping revenue from lower-cost power producers. Von der Leyen's proposal is just the start of what's likely to be fractious discussions among EU nations. In the UK, inflation has gone down slightly from its highest rate in 4 decades. The Consumer Prices Index, it rose 9.9% last month from a year ago, a drop from 10.1% in July. That reflects an almost 7% decline in the cost of gasoline. Bank of England policymakers meet next week. They're expected to raise interest rates either by 50 or 75 basis points. Comcast is doubling its share to buyback program to $20 billion. The parent of NBC Universal is taking advantage of the shares, having lost a third of their value this year. Comcast has already bought $9 billion of its stock in 2022. Global tech investor SoftBank reportedly is considering the launch of a new giant startup investment fund. According to the Wall Street Journal, it's part of a plan to rebound after the poor performance at its 2 earlier funds. SoftBank has been hit hard by the rout in tech stocks. It posted a record $23 billion loss in the quarter ending in June. And hotter than expected U.S. inflation data had caused Jeff Bezos' wealth to fall $9.8 billion yesterday. It was the largest plunge on the Bloomberg Billionaires Index. Elon Musk's net worth dropped by $8.4 billion. And they're not alone. The fortunes of America's richest billionaires fell by $93 billion, the 9th worst daily loss ever. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists. I'm Lisa Mateo. This is Bloomberg.
This is an extended edition of Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from London for our audience worldwide. Good afternoon, good afternoon. A special edition of Bloomberg Surveillance. The countdown to the Open begins right now. 30 minutes away from the opening bell. Futures trying to deliver some kind of bounce after a brutal day of losses in yesterday's session. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. TK struggling to put together a bounce this morning.
Yeah, it was a difficult bounce. It was a better tape a bit ago, and then there was a real ebb to it, and it sort of claws back. But to me, it's highly correlated, and it is a data dependency that sobered everybody up yesterday, shifting from SAR to soft to what kind of landing.
Hard.
And the question is, John, what's the next data dependent in between us and the Fed is tomorrow's retail sales.
Retail sales, Lisa, will it actually make a difference, considering everyone's on board now for 75 from this Fed next week?
It just will make a difference on the margins for the progression from there. In other words, how much does the Fed have to stomp on the brakes, right? I mean, this is basically a market looking to the Fed to reduce the momentum, to by design engineer some sort of slowdown that is going to, by design, have to be a bit harsher than they previously
I do
perhaps
wonder
thought.
what these forecasts look like next week.
It's a good question.
Are we going to see much higher unemployment baked in to get CPI where they want it to be?
And do they change them between what we saw yesterday and then? And my answer is they do. They tweak them right up to the end.
We're going to look forward to that.
Michael,
right here on Bloomberg TV and radio. Futures shaping up as follows, just about positive on the S&P and on the Nasdaq too. Certainly not the story of yesterday, with the S&P 500 down the most since June 2020. We're positive 0.2 on the S&P, on the Nasdaq up by about a third of 1%. Lisa's been all over the bond market, and quite rightly. It's not just about 10-year yields higher. It's about a 2-year yield that is much, much higher, up 4 basis points, and briefly this morning through 380, at the moment 379.65. Mike McKee's got a lot to say. Mike McKee, we need to talk about the data yesterday, this morning, and tomorrow.
Yeah, John, take a look at what we saw this morning from the producer price index, and you might think things are not all that bad because producer prices on a headline basis fell 0.1%, exactly as we had anticipated. But it was the core rate, once again, that is a little bit higher than had been expected. We see it come in at a 0.4 gain, up from a 0.3 gain the month before. But it really just piles on to the whole headline CPI, core CPI story from yesterday that you guys were just talking about. If you look at what's happening with CPI, there is one line that just should scare everybody, and that's the number of categories that are seeing inflation above 4%. That's the purple line there. That is 60% of the categories in the CPI are seeing inflation above 40%. And that white line is the number of categories that are moving towards zero, and that's getting smaller. So you do see, as you guys were saying, you do see this Fed probabilities move up. We've now priced in for March 4.3, almost 4.4%. So you can see the bottom there where we're going next month, or this month rather, next week, and then where we go from there. I just have to conclude by sort of pointing out everybody has an opinion about what is going to happen. Larry Summers said the Fed needs to cut by 1%. Jeff Gundlach said, raised by 1%. Jeff Gundlach said they need to raise only 25 because they're going too far. And Elon Musk says they should cut 25. So who's the Fed going to believe?
Mike, frame retail tomorrow, and I know there's an inflation issue there. With the enthusiasm for the consumer, I hear from Michelle Meyer at MasterCard, from James Glassman at Citigroup and others, that all this talk of Fed and the financialization and the money side of the business buttresses up against a buoyant consumer. Is the consumer buoyant?
Well, it's going to be interesting to try to divine that from the retail sales numbers tomorrow, Tom, because first you have the overriding issue of, did people have more money to spend on other things because they were spending less on gasoline? And do people want to buy goods instead of services? Now, we do have this retail sales report encompassing the back-to-school season, so there might be some news there. But also housing collapsing. We saw another drop in mortgage applications today. And so what's happening with furniture, with appliances, building materials? Are those going down with the rest of housing? It'd be interesting to see this tomorrow.
Hey, Mike. Thank you. Mike McKee there, breaking down some of the data. Tom, Lisa, Mike Gapin of Bank of America out just moments ago. Lisa is now looking for 75 next week. There was a lean towards 75, away from 50, but 75 is their number. 4% on Fed funds by year end. That has quickly become consensus, hasn't it?
And that is a game changer from where we were a couple of months ago. The question is if they're going to hold it there, right? I mean, basically, the Fed officials have said, we're not going to cut rates next year. Stop thinking that. Stop pricing that in. If they hold rates at 4%, to Tom's point, can the economy withstand that, given the amount of debt in the economy, given how much people have gotten used to zero rates?
I would suggest you will clear out the zombie companies. A good part of the economy will withstand it. We've had a zombieization. Is that a word, John? We've had a zombie. We'll make it a word right now. It's a surveillance vocabulary. There's been a zombieification of the American economy, and we're going to clear it out at those rates.
Raises the question why credit's been so resilient in the face of some of this. Zach Griffiths joins us now.
Let me look it up now.
Senior investment grade strategist at Credit Sites. Zach, can I begin with high yield and not investment grade? And can I ask you why you're seeing the signs of resilience in that part of credit that perhaps are surprising some people?
It is surprising, Jonathan, when you think about the move in risk markets broadly yesterday, and to see spreads hanging in relatively well. And to us, we think that there is a lot of bad news priced in, and we recently looked at the wall of maturities coming up, and you're just not seeing a lot of maturities that are going to need to be refinanced at these higher rates in the near term. So from a fundamental perspective, we think there's a lot more flexibility for some of these high yield issuers, the higher rated high yield issuers, than we've had in some past cycles, that aren't going to have to absorb these higher borrowing costs in the near term. And it's really going to come down to what we were talking about earlier with the consumer. Is it as resilient? Can it remain buoyant and keep earnings buoyant over the next couple of quarters to keep high yield hanging in there? We think there's a decent chance, although our base case is spreads widen a bit into year end.
So, Zach, I want to double down on this and really get you to explain, because we heard something similar from Wei Li, that a slowdown was already being priced into credit spreads, even as you have the like of JP Morgan's Bob Michael coming out and saying, actually, they've got a lot more to widen. They have to recognize the pain that stocks are starting to price in on the margins and moves like what we saw yesterday. So what kind of slowdown are credit spreads currently implying?
I think you're seeing an implication of something south of potential GDP, at least. I'm not quite sure that you can say a recession is priced in yet. And we're not calling for a recession. We think that you're going to see a growth slowdown when you have the Fed tightening rates like this. You have the 10-year real yield moving as high as 1%. That's certainly going to have an impact on the economy, but it's tough to balance just how much of the fiscal and monetary stimulus we've had over the past couple of years is still floating around in the economy. We still see indications that there's money to be put to work. You certainly had a big reopening of the investment-grade credit market after the Labor Day holiday. And not to point to something that we've been talking about for, it seems like, months, but all of the cash on the sideline in the Fed's repo facility. So I do think that there are some counterbalancing factors. I think there's a slowdown priced in. It's hard to say exactly how much at this stage.
How long would rates have to stay high before it became a problem? And I say this with respect to what you were saying about the maturity wall, how it's going to take a number of years before some of these companies actually have to refinance. What's the time that they have, the breathing room?
I think that's about a year, maybe a year and a half. And if you have rates remaining high or moving even higher, still that's going to be a problem because you're obviously not going to wait up until the very end as these maturities come due. They get refied a certain amount of time ahead of the actual maturities. And so when you think about if the Fed were to take the policy rate all the way up to 4.5%, which seems very possible to us, and hold it there for something like a whole year, which the market is certainly not priced for, I think that's going to cause problems for the economy and for credit.
Zach, at credit sites, you people have the pulse of what corporations are doing. I see corporations that are underdebted, particularly quality corporations. As rates go up, what kind of sweat do CFOs have? Are they breaking out a cold sweat because they're saying issue now, or do they pull it in?
I don't think the cold sweat is here yet, Tom. And again, it kind of comes down to this story that maturities are not significant in the next year or two because of all of the opportunistic refinancing at very low rates that we've had over the past couple of years. So again, it gives these corporations, especially higher rated ones, a lot more flexibility coming into a time of economic headwinds and monetary policy headwinds.
Are you monitoring that they're using debt issuance simply for equity retirement, equity share buyback?
That's definitely something that we monitor and is a cause for concern if there is too much issuance to simply do share buybacks. But I think that given the clarity, at least around tightening, perhaps not the exact degree, balance sheets are being shored up and some of those considerations are being taken a bit more or less lightly, I suppose would be the way to put it. And so that's not something that is keeping us up at night just yet, but definitely factors into our overall outlook.
See how diplomatic he was on that?
I think he's been very
just
diplomatic.
Absolutely nailed that.
He's got a new seat, so he's being very diplomatic.
He just nailed that. Zach nailed that.
Hey, Zach, congratulations on the new seat. It's good to catch up, sir. Zach Griffiths there.
Thank you.
Of Credit Sites. I think on the edge of constructive on the credit market there, Bramo, would you say? On the edge of constructive?
Certainly more constructive than a number of people who think that credit spreads still need to widen. It kind of goes back to the theme that we've been talking about all morning, which is just how deep is the slowdown that you have to expect to get inflation under control. And, well, that's what equity seemed to suggest yesterday. But
that's what John suggested.
Yeah, he was clearly just putting that out there. No.
You know he's going to join us in about 20 minutes. Oksana Aronoff of JP Morgan. I'm guessing Oksana is not constructive on this credit market.
I would guess not, and I'm curious what she has to say about some of these other issues that people are raising, such as fundamentals that look pretty good, the fact that they don't have necessarily a maturity wall, and this was the other point that Zach mentioned. There still is so much liquidity in the system that hasn't yet been drained. Does this perhaps be the place that we talk about quantitative tightening? Yeah.
QT.
Yes, you know where I'm going with this.
So if you compare late 18 to now, and we've touched on this a few times over the year, and I know we did it earlier this morning as well, the biggest difference between now and late 2018 is that it's worse. Not that it's better, because we don't have a central bank put anymore.
Correct. And you also have the quantitative tightening that's accelerating. So when people say, well, they're still looking to buy things, well, yes, they are, because we don't have necessarily the withdrawal of liquidity yet. When that starts to kick in, does the conversation start to change?
How long before we start talking about the Fed pivot again? based on a jobs market that's okay, a payrolls report that looks like Goldilocks, and
week and a half before
the moves on again.
Well,
Chairman Powell's going to have to read the same speech twice, 3, 4 times. We've mentioned that a few times too. Futures up 1/3% on the S&P, on the Nasdaq up 0.4%, on a Russell up 0.2%. We've talked about yields climbing, discussed that all morning. On a 10-year, a 2-year, briefly through 380 at one point this morning. JP Morgan's Oksana Aronoff is going to join us in just a moment alongside Wells Fargo's Samir Samana. We'll do that around the opening bell. Before we get there, look at the sun in London. If you're on radio right now, you're missing out. Glorious day developing in London as the Queen's coffin is set to move from Buckingham Palace to Westminster Hall. Guiding us through that, Lizzie Burden and Guy Johnson in just a moment. Live from London, with equities higher, 17 minutes away from the opening bell in New York. This is Bloomberg.
The stock market doesn't necessarily reflect the state of the economy, as you well know. And the economy's still strong, unemployment's low, jobs are up, manufacturing's good. So I think it's, I think we're going to be fine.
Are you worried about the inflation number, though, sir?
No, I'm not.
President Biden brushing off inflation concerns after an upside surprise at the same time. For more, down in D.C., Bloomberg's Anne-Marie. AMH, let's start there. How cumbersome a lot of people thought that was just yesterday. Clumsy, almost, to be looking at inflation where it was, markets with what markets were doing, and the message that we received from the White House at the same time.
Yeah, it was quite awkward, and Greg Valliere leads his note with it, calling it tone deaf, saying rarely have we seen such a tone deaf day in this city than yesterday. As markets were crashing, the president, with hundreds of people, were celebrating the, quote, Inflation Reduction Act. You had James Taylor singing Fire, Rain and Fire, and at the same time, there was no mention at all of the inflation data that had just come out that morning, which was worse than expected. So for many, it was an awkward moment. Even someone said to me, did anyone look at the calendar to match up that you were going to get this inflation data and have this other celebration? So that was quite awkward. And then the president had said later in the day when he went to Delaware to vote that he wasn't worried about yesterday's print.
And my most depressing part of this trip, Anne-Marie, is knowing that you're not sure if it's fire and rain or rain and fire for James Taylor. I can tell you that when that song broke, I was at the University of Colorado, thunderstruck of what James Taylor did with his left hand on a guitar. Why was James Taylor at this event? What is the messaging? The president, and John mentioned this earlier, the clumsiness sometimes of the message there. How do you drag the songwriter from Martha's Vineyard into an event at your White House?
Yeah, and what's interesting, and I think given the fact that I just stumbled on his song there, you can show that the administration wasn't exactly going after the youth vote with this one, but it really has to do with his moves on climate. And he spoke about that, the fact of climate change, and that was his big message as he was giving this performance, that he wanted to make sure there was this legislation to enact big money going towards climate change. The president is also going to take that message today to Detroit at the auto show. He's going to be talking about electric vehicles and these tax breaks that can go to EVs. And this is, you know, part of their transformation of the energy crisis. Another kind of awkward moment at the same time. The White House's biggest metric right now in the economy has to be gas prices. That's what Ron Klain was tweeting about this morning. It's what the White House has been tweeting about for weeks, because right now it's in a much better place going to the midterm elections than it was at the peak in June.
I'll go one step further. I've never heard the song.
You've never heard the song?
I've never heard the song.
I'm less embarrassed now.
Not big on this, yours.
I'll sing.
Oh, I look forward to that.
In the break.
Anne-Marie, down in DC. AMH, thank you. Like a TK kind of song, or like a good voice?
Do you want me to do it?
Sure.
No, thanks. Let's skip that one.
We've got some special team coverage to go to right now with Bloomberg's Guy Johnson in London and Lizzie Burden at Abington Green. Let's start with you, Guy. What we're about to see in about 30 seconds' time as these palace gates open here in London.
Due to start any second now, 22 minutes past. We are 21 minutes past. We're about to be 22 minutes past. You can see the pictures coming from Buckingham Palace. A procession that will take the Queen's body to Westminster Hall. There will be a ceremony there that will last around 20 minutes' time, John. And after that, at 5 p.m. this evening, the gates will open and people will be allowed to pay their respects as the Queen lies in state. Some suggestion that the queue could be reaching up to 10 miles long. They're preparing for 5. It could be as long as 10. The British public want to pay their respects.
Lizzie, you've been watching the whole scene. Lizzie, what's your sense of how deep some of these lines are, of how much the crowds have been assembling?
Well, they've been queuing for days. They've been queuing overnight, despite the rain, despite the warnings of 30-hour-long queues. But people are jovial in the queues. They seem to be making friends with each other, asking, just hold my spot so that I can go and grab some food. They're just desperate to pay their respects, show their affection for the Queen. I think it's poignant to remember Boris Johnson's tribute to who he called Elizabeth the Great. It's unlikely that we'll ever see an outpouring of national grief like this, or that we have seen one before, or that you would have a British monarch reign for 70 years in our lifetimes again. This really is history.
Guy Johnson, in the mourning that we've seen the last number of days, we also have myth building going on. It is about a united kingdom, including King Charles yesterday in Northern Ireland. That myth making is always at tension, and in Westminster Hall, we've seen that. The judiciary history there, including the gunpowder plot, is extraordinary. How unified is this nation around the imagery that King Charles is trying to construct?
He is building on his mother's legacy. He clearly wants to use that legacy to launch his own reign. Understandably, it is a long and storied history that Queen Elizabeth has been able to generate, and a lot of goodwill goes with it. I don't know yet, Tom. It's too early to tell. We will see what happens ultimately as this story develops, how he handles himself, not only over the first few weeks, but over the first few months and years, I think will be really significant here. At the moment, we are still in the afterglow of the Elizabethan era. We don't know what comes next. That is the challenge. That must be shaped. And I think that is going to be a difficult job for the new king to achieve. I think it's going to be a difficult job to generate the same kind of love and enthusiasm that the Queen, whose casket you see there, has been able to produce.
The King's Royal Troop, horse artillery, taking the Queen's coffin down the Mall, up towards Horse Guards Parade, and then onto Whitehall, Guy, and then from there onto Westminster Hall. Guy, now typically this would take, what, 15 minutes to walk? I imagine this procession is going to take a whole lot longer.
Absolutely. That is a gun carriage from the Royal Horse Artillery. The Royal Horse Artillery, I think 7 RHA, will also be firing a shot for every minute that it takes. I think they'll probably be firing a number of rounds. I think this is going to be a slow process, a process that is a recognition of her legacy. There are people that want to see her. This is about pomp and circumstance. It's about legacy. It's about wanting to show our appreciation, and that is going to be measured in some ways in time here, John. This is a long drawn-out process that we are going through here right now. Since the news of the Queen's death to her funeral, it is a long drawn-out process, and that is a recognition of her impact, not only on this country, but the world.
We're with friends, no one's watching. They're not listening.
We're done.
No, come on.
Come on,
Carry on singing.
No, it's
no, you
good.
can't
It's fine.
start seconds before
Look at
we
that.
come back. And
NASDAQ future is poised to eke out just a little gain. Come on, keep going.
you're not going to sing us into the opening bell.
Come on,
Unbelievable. Up a third of 1% on the S&P. NASDAQ futures up 0.4%. Big move lower. Closed almost at the lows in yesterday's session. Tiny bounce. In the FX market, euro just a little bit stronger, up by 0.2%. Stronger against the US dollar, and yields higher by 3 basis points on a 10-year. 343.72. Twos this morning, Tom. 380.
You guys have been on the 2-year today, and you're correct on a standard deviation basis. I want to point out the VIX didn't pop to a 30, 31, 32. The VIX was like a 27-ish, and that's not, as I mentioned earlier, we reset. We did not collapse.
Am I getting a song?
Oh, I've seen
There we
fire.
go.
Right,
that was beautiful. That's enough. That's
Thanks,
special.
that's good. Okay.
I can clip that now and put it on repeat.
Great, thanks.
Joining us now, with some stocks around the opening bell. Here's Abby. Hey, Abby.
Much better that you're singing than me, Lisa, for sure. And I can't believe, John, that you've never heard that song. As for stocks, we do, of course, have a little bit of a rebound after the worst day since March of 2020 for the NASDAQ 100. That has everything to do with the fact that your Apples and Microsofts are higher on the day after the worst day for Microsoft and Apple, going all the way back to September of 2020 on that surge in yields. Occidental Petroleum popping 1.2% up with oil. So it's a little bit of a broad-based rally. You also have your banks higher. JP Morgan had been up a little bit more earlier with yields higher. We would be remiss, though, if we didn't talk about the railroads, because, of course, there is the possibility of a strike if a deal is not struck by Friday. 100,000 workers may go on strike. If that happens, John, of course, it would mean rising prices in the form of higher shipping costs. The railroads on the day are down, including Union Pacific.
Abby, thank you. We've got to turn to the inflation story. Big upside surprise yesterday. That print fueling the biggest day of declines in more than 2 years on the S&P 500. Katie Lyons has more. Hey, Katie.
Yesterday was an absolutely brutal day, but it was more brutal for certain areas of the equity market in particular. Brutal, Tom. Yes, indeed. The likes of the home builders, consumer discretionary, technology, all the big laggards on the day yesterday. Although this morning they are seeing the smallest of rebounds. Still very, very small. In fact, the home builders now turning negative, as is the case for some of those retail stocks as well. Obviously, even the gains of today we're seeing for the likes of technology doesn't do much to unwind the pain of yesterday. The home builders, for example, down 7% on the day. Retail and apparel each down about 6%. You had the tech names down in the ballpark of 5% as well. Crushed, brutal, whatever you want to call it. It hasn't just been a one-day story. It has been tough going for these stocks really since we saw inflation first become elevated in May of 2021, and for obvious reasons. The home builder decline of about 21% since that time period goes hand in hand with the idea that if inflation is high, the Fed has to raise rates to rein it in. That means mortgage rates go higher and housing demand cools. We've already seen that borne out in the economic data. And for consumer discretionary and tech stocks, we know that that is because a lot of those stocks command higher multiples. And when you command a higher multiple and rates are rising, that value of earnings going forward that so much of your price is based on is devalued, which is why we've seen a lot of these stocks coming back down to earth. And of course, that is a higher rate story, which brings me to the bond market. We have seen so much work done in treasuries on a year-to-date basis, specifically at the short end with the 2-year yield up 300 basis points or more since the year started, up nearly 200 basis points for the 10-year. But it's not just nominal yields really that we need to look at. It is real yields, inflation adjusted. We are very close to 1% on that 10-year real yield, John.
300 basis points year to date on a nominal 2-year. That is just unreal. Katie, thank you, by the way.
And to get where total return is, this is really important. Insane. No one is prepared for the simple breakdown in price of the Bloomberg Aggregate Total Return Index. We're not there yet. We're close.
Bramo, that move is phenomenal, isn't it? It really is.
Especially considering that for years people were saying that this economy couldn't withstand a 25 basis point rate hike or 50 basis point rate hike, and suddenly we're climbing very quickly and we're seeing a real shift as people expect that much more.
Compare and contrast this cycle, this rate hiking cycle, to the last one.
Yeah.
How much they did over, say, 3 years and how much they've done in 6 months.
Front loading, right? But when do we see the actual effects, and how long does it take to trickle into the economy as well?
Well, we've asked the question, haven't we? Front loading or just delayed and catch up?
What was it? Christine Lagarde? Who was that?
Yes.
Jim Bianco?
That was Jim Bianco.
That was brutal.
Bianco Research. You're going to play nice today. You're going to play nice today.
I just thought what Jim Bianco said was brutal.
I agree. Brutal's the word of the day. JP Morgan's Oksana Aronoff joins us now alongside Samir Samana.
They're both brutal.
Global market strategist at Wells Fargo Investment Institute. Oksana, let's go first to you. Are you seeing any value in this market yet?
Well, first of all, let's level set. Tom mentioned the performance of bonds year to date. And for the global aggregate, the Barclays Global Aggregate, bonds are right up there with equities. Equities in the U.S. down 17%, at 17.5%, and global bonds down almost 17%. I bet you no one could have possibly expected this turn of events. And of course, you know, earlier this year, I've been very, very assertive in my view that it was too early to get into bond risk, and that continues to be the case. And I know that sort of the preferred mantra out there, at least as it relates to credit, is that, oh, you know, the maturity wall is still out there. It's not kind of breathing down anyone's neck. However, it's important to remember that half of all high-yield maturities occur about 2 years before that maturity wall materializes. So happy to talk more about that. But obviously, as stress continues to make its way through fundamentals, through profit margins,
right,
and we're starting to see some of that stress, particularly in the leveraged loan space where we are seeing elevated defaults and downgrades, we're going to continue to see now the credit market start to catch up to the realities of high rates.
I'm going to suggest, Oksana, this is original territory, to use the all-time cliche. When we break down under a negative 16% price move, negative 18%, what will be the action of those debt holders? How will they, we've never been here, how will they respond to those simple price declines?
How do you think they will respond? How have they responded in history?
Wait,
right now,
I'm interviewing you. You're not interviewing me.
I mean, I think we've seen this all play out before, right? Investors do not typically like to sit on losses, particularly not on losses in what's supposed to be the most sort of, bulletproof part of their portfolio, bonds, right? So investors sell, and we know there's research around this. Investors tend to sell at the worst possible time. And that's really going to be the capitulation point, which we certainly haven't seen in the credit market. The credit markets are still pricing well below any sort of recession, and we are increasingly staring at, if not already in, recession. And we're seeing, one of the areas that also gets talked about a lot is the fundamental strength of the corporate market. And I think that is present. However, if you look at the trend, you see that profit margins, yes, they have remained strong in Q2, but if you strip out energy and transportation, which of course benefits from lower energy prices, you see that those profit margins have actually come in at negative 1% quarter over quarter and minus almost 6% year over year for the rest of the lower rated market. And they're led by, lower profit margins in retail, in healthcare, in food. So all the areas that find it very difficult to pass higher costs on to the consumer. And that trend will continue. Profit margins will continue to experience problems, and we will continue to see it reflected in spreads.
So, Oksana, next time we have Zach Griffiths on, we'll bring you on and we'll have you together so we can really get a tit for tat. It seems like you guys have opposing views. Samir Samana, I'd love to get your take on this because we heard earlier in the program from Zach Griffiths, who is of Credit Sites, who is saying that credit spreads have already baked in a significant slowdown and talking about the maturity wall and the corporate strength. Where do you stand on this? Do you agree with Oksana that there is much more that credit spreads have to widen, that there has to be an inference of greater pain inferred into the credit market than is currently?
I think there's a difference between kind of fair value and kind of where the Fed has to take things, and they probably have to take things beyond fair value just because things are, overheating right now, at least from an inflationary standpoint. So, again, you can have fair value being overshot. That being said, credit spreads right now probably don't fully, kind of embed the reality that's probably ahead of us. If the Fed's going to take, interest rates on the short end to 4.25 by year end, it seems like they're, everybody's on board with front loading now. Which should mean the slowdown, the recession probably is in the first half of next year, which is what we've expected for some time. Then credit probably does have one more shoe to drop. Now, that being said, there are emerging pockets of opportunity. I think what's happened with commodities, the fact that oil was, kind of in the low 80s not that long ago, commodities. We like energy equities. Those continue to be a very small percentage of the overall benchmark. We think there's some attractiveness there. But we would continue to fade, consumer discretionary and real estate. Those are probably both rate sensitive and haven't caught up to where the consumer's health is going.
Given the carnage that Tom and Oksana have been talking about within the total return index and bonds, where do bonds fit in your portfolio, given what we've seen with 60-40 this year?
So we really like the short end, right? You're getting paid to kind of, sit and kind of clip coupons in the short end. We also entered the year most unfavorable on long-term fixed income. We took the opportunity earlier in the year around 3.5 to go to neutral. That's probably a good spot for now. That being said, if you do get overshoots to kind of the 4% area or maybe even higher, I think we would see that as kind of a longer term opportunity to kind of have that ballast in our portfolios, because again, we do believe the Fed will eventually get inflation back down to that 2% target.
Samir, let me just ask you a question on that. If they do get inflation back down to that 2% target, what matters here is time horizon and damage done. Over what time horizon and how much damage will they do to this labour market in between?
So I think it's going to take a lot of time. I mean, you could easily bleed into 23, maybe even 24, and there probably is a good bit of damage done to the labor market. I mean, unfortunately, the Fed's kind of been in this have your cake and eat it too standpoint, where unemployment's only going to tick up slightly, and you're going to somehow get inflation back down. We've just not been in that camp for some time, which is why we remain very cautious on equities. Right, we're underweight smalls, we're underweight emerging markets, we're underweight developed markets. We're fading, kind of the consumer-oriented sectors. So, I mean, we're in a pretty defensive posture. I think we'll get some opportunities to get a little bit more aggressive, but I think we're on the front end of this.
Samir Samana, thank you, sir. It's good to catch up with you. Oksana Aronoff is going to stick with us for a final word. Lisa, that was bearish, and it was kind of the bearish tone we heard from Max Kettner of HSBC when we started the program first thing this morning.
We've heard a lot of bearishness. I mean, it's not just us. People can accuse us of having sort of a tilt in whichever way we want to have it, but this is a reflection of what we're hearing from an increasing number of people, which is why it's sort of surprising that the reaction yesterday was as violent as it was to the prospect that the Fed was actually not lying when it was saying that they were going to raise rates, and they were going to raise rates until they saw inflation come down.
Well, the mistake was the rally going into the number. The 4-day rally into CPI, Tom. 5% rally on the S&P 500.
I take issue with the idea it was a crater, a panic, a crush, whatever you want to call it. It was a reset back to where we were
before
5-6 days ago.
Sure.
That's different than the action. With that said, the way we closed yesterday afternoon was ugly.
Ugly? Brutal?
Really ugly. It was brutal.
It was brutal. Good. There we go.
Yeah, there's no question about it.
We agree on something.
I just remember James Taylor was at an American Economic Association convention.
I didn't know that.
We did a concert. Yeah, I think Robert Mundell spoke, and then Taylor got up, and he's got the J50 going and that, and he goes in, he goes, "Do me wrong. Do me right.
This is special, okay.
Tell me lies. Get the inflation call right." Place roared.
Did you play the guitar?
No, I did not. He played the guitar.
He played the guitar.
Oh, yeah.
But you can play the guitar.
Those diminished chords were something.
When you make your way to TK's home, there is a guitar in each room, just sort of on the floor. I'm not sure why are they all on the floor? Why are they all on the floor? Why are they not on stand?
There's just always
on the floor,
another
in each room.
reason.
I've never understood that.
I said to David Gurr, he goes, "What's the next guitar?" And I go, "We can't talk about the D45 Martin that needs to be in the house."
He's set up a whole studio now.
I
have
know.
You seen this yet?
I have seen
the whole
it.
sound
It's
studio.
pretty impressive. It's
very cool.
His passion.
It's his passion for when he's not
Why
reading.
was James Taylor at the White House?
I don't know. James Taylor just never made it to the UK. It just wasn't a thing.
That's interesting.
Just wasn't
like baseball.
Just wasn't a thing. Yeah, we call that rounders.
Interesting.
We call that rounders, baseball. You just sort of one-handed. You hit a ball and then you run in a circle. That's what we used to play at school.
So, like, if I say, John,
I'm told that's what baseball
help me
was
here,
based
John.
on.
What? No, that's he is
if I
absolutely
say,
trying to make people.
They based it on rounders. They did.
You're ignoring me. If I say the band Traffic,
That's not the case, is
do
it?
you know Acoustic Traffic?
No.
Are you serious?
Well, we can talk about it in the break.
James Page?
No.
In these times, it is wrong to receive extraordinary record revenues and profits benefiting from war and on the back of our consumers. Our proposal will raise more than 140 billion euros for member states to cushion the blow directly.
Ursula von der Leyen there at the European Commission just a bit earlier today. She went on to talk about rounders too and how it's it's formed baseball later on.
You want me to do this?
No, I'm joking.
Okay.
Equities are up a half of 1% on the S&P.
I would suggest that
we're firmer by a half of 1% also, Tom.
John, I would suggest von der Leyen is the former defense minister of Germany, is encyclopedic on Germany's ability to help Ukraine.
Yeah.
It's something people don't know. She's
I agree.
encyclopedic.
Also encyclopedic on the mistakes that have been made.
Yes, but she's truly encyclopedic on their military ability.
Oksana Aronoff back with us for a final word over at JP Morgan. Oksana, on Europe, we've had a lot of guests on the programme, and they approach the situation in Europe as follows. Not if there'll be a recession, how deep it will be. Do you have the same approach right now?
Yes, definitely. Europe, of course, is dealing with issues that the U.S. is somewhat insulated from. We talk about energy and how energy has let up here in the U.S., for example, but European gas prices are on the rise again. And so, without a doubt, there is definitely a lot of focus on how deep that recession will end up being. And we're seeing it in investors being, to the extent they're underweight equities, are really majorly underweight European equities specifically, right? And much, much less so in the U.S. They're essentially flat in terms of their U.S. equity exposure. So without a doubt, the issues there are much more significant. We're seeing it in higher spreads, slightly more elevated spreads, lower returns year to date. So absolutely.
Right. What's your visibility to 2023? I'm fascinated by the September reset. It's way too early to talk about a year-end review, but do you have any view, Oksana, to how to invest into 2023, or are you just making it up as you go?
I will tell you one thing. I take a lot of issue with what the market is pricing in for next year, which is nothing other than the Fed making a U-turn and becoming accommodative. And it is quite clear to me that the Fed is going to pursue its aggressive stance and eventually become perhaps neutral, but not accommodative. And that's not what our prices are reflecting right now. Someone earlier mentioned our last hiking cycle, the 2015-2018, which was extraordinarily benign. We had inflation at barely 2%. We had higher unemployment, and still we had, for example, lower credit spreads after the last Fed hike back then were in the high 500s, 575, if I remember correctly. And today, when someone talks about fair value in credit, what's fair value right now? High yield is pricing significantly below 20-year average. Forget, 20-year recession average. So I think there is definitely a lot of complacency still being placed into this market, being priced into this market, and we need to really be focused on high quality floating rate, very short, but floating rate preferably, and really wait for that capitulation point. That will be my tip-off to start to really get more aggressive.
Just to put a bow on this, Oksana, how much of your portfolio is in cash-like instruments, and how much have you been building that?
So we came into the year already quite defensively positioned, and we've been building it throughout the year. Yes, we've been tactically trading, the curve and taking advantage of the backup in yields at the front end of the curve. But as far as sort of more strategic, allocation to longer-term risk in the interest rate-driven or credit-driven markets, we've really tried to stay back and actually build our liquidity. We are still, or actually have arrived now at around 70% liquidity, which is, focused again on those high-quality floating rate structures. And we think that capitulation point will happen. We're just starting to see markets reckon with the reality that this Fed means what it said, with the reality that higher cost of capital is not going to be great for fundamentals. And even this is really important to understand, that we don't need to see a 2008 or some kind of dramatic recession occur. We just need to see historic defaults start to move towards historic average in the corporate sector of 3.5%. Right now they're at 1%, to start to see those spreads widen dramatically compared to where they are today.
Oksana, you need to let us know when you're ready to put that cash to work, because we need to cash out when we get to that moment. Oksana Aronoff at JP Morgan. Tom.
In fancy talk, John, 70% liquidity, floating rate. She's on the edge of the triple leveraged all cash fund.
I would say that was pretty gloomy, pretty bearish.
Yeah.
I have to say. That's a lot of cash, Bramo.
70% liquidity. At what point do they get the conviction to deploy, I think is the right question.
30 minutes ago, the late Queen making the final journey from Buckingham Palace to Westminster Hall. Lizzie Burden's back with us from Abington Green. Lizzie, walk us through the next couple of minutes.
Well, the Queen's coffin is making its way from Buckingham Palace to the Palace of Westminster. It's already been down Pall Mall, a Horse Guards parade. It's approaching Whitehall. Really places to people outside the UK, perhaps just names on the Monopoly board. But this is the Queen showing her old adage, she needs to be seen to be believed. The coffin's going to arrive at Westminster Hall, and she'll lie in state until Monday when the funeral happens, and people are going to be able to file past and pay their respects. They've been queuing for days overnight, despite the rain, despite the warnings of a 30-hour queue. But really, this is the magic of monarchy, isn't it? The king is going to begin his reign with this sharing of the national outpouring of grief. You've got this king flanked by his children, his siblings, on foot behind the coffin. It really is a symbolic moment, and it evokes the memory of when when William and Harry walked behind their own mother's coffin 25 years ago.
Lizzie, I would say the imagery right now, and for those of you on radio, it is as you would expect, except we're seeing generational imagery. This is really the first time, Lizzie, we've seen the generations of her descendants together.
And I couldn't hear anything.
I think we're having technical problems. Okay, thank you.
We've lost Lizzie Burden.
That happens.
From Abington Green.
With 400,000 people there, that can happen.
So, Tom, a deeply emotional moment for this country. The Queen's coffin making its way to Westminster Hall, followed on foot by senior royals, the royal family, including the King for that matter as well. Tom, as I mentioned a little bit earlier this morning, this walk from Buckingham Palace up the Mall, through Horse Guards Parade, through the Horse Guards Arch, onwards through Whitehall, Tom, onto Westminster, can take 15 minutes or so. This is taking about 40 minutes, giving everyone the opportunity to pay their respects as the Queen makes that final journey, Tom, to Westminster Hall.
And the compression here, John, I think for so many, particularly in America, including myself, we don't understand how all of this bureaucracy of government over centuries is all compressed into this square mile.
So where they're going through Whitehall at the moment, Tom, they are the offices of government. And then on to Westminster and the House of Parliament and the buildings that you're so familiar with. Lisa, we did this walk together just on Sunday mornings. I've said a couple of times already. It is the final journey of this Queen to Westminster Hall, where she will lie in state for 5 days, from today through to Monday morning. The opportunity for this country to pay its final respects to the late Queen, Elizabeth II.